Welcome back to the We Are In conference. When Katrina and Helen approached me.
Sorry, we're yes. not quite yet. One moment.
Not?
One moment. When I take down the slide, that would be fantastic. Thank you. No problem.
Welcome back to the We Are In conference. I'm Luc Laven, and it's my great pleasure to open the second day of the event. When Helen Ray and Katrina Mendicino approached me with the idea to organize this event, I didn't have to think hard or twice. I think it's a wonderful idea. And my main message is keep it up and please here. I think it's really important. I think on the one hand, as Claudia Golden famously said, over the 20th century, there's been a major convergence between men and women in terms of educational attainment, in terms of wage gaps. But that's not everything. A lot more has to be done. And it's very evident that there is a major issue in the profession in terms of norms and values. And it's for those reasons that events like these, even though to some outsiders may seem somewhat unusual to have only one gender, are really crucial. I think the only, when speaking to Helen and Katrina at the infancy of this project, my only suggestion was a modest one to try to make it global. And I'm really, really glad to see that they came up with the idea to join forces between the US and Europe. So we really have a very truly global event here, and I'm very proud of it. So I realized that I'm the only male speaker on the program. So on the one hand, I feel very privileged about that, but I take it also as a soft signal that I should be brief, because today is not about men, it's about women. I just want to pause by saying three things about what we have done at the ECB in this important area. Mainly because I'm addressing the audience, knowing that many of you are training the future generation of female economists. So at the ECB, we have launched a Women in Economics scholarship program. This is targeting bachelor students and especially those in financial need. And we are helping them to pursue master degrees in economics. And so please make your students aware of this program. It really, really is the beginning of what ultimately often becomes a very strong network. The second program that we established is the program, and this targets PhD students, and they spend the summer with us to work on their thesis and also get a glimpse of how it is to work at a central bank, but more importantly, again, to interact with researchers and again, expand their network. Many of those students we've stayed in touch with, and indeed, we now see that some are actually joining us, so which is really, really nice to see that and them staying in touch. And the last thing I wanted to highlight is that at the ECB, we also take the issues seriously, and as economists want to do research on gender issues, and our HR department has opened up also the personnel files. And I just wanted to highlight one recent research project that was led.
We seem to have lost Luc, and he was getting to his final point. I'm sure he will rejoin us.
We didn't do that because he was a male.
Yes.
Then we would have just muted him.
I can't see him joining instantly back. I think he may have had a problem with his Wi-Fi. I would suggest potentially we continue with the program, and I'm sure there will be a moment for Luke to finish his wonderful introduction. So yes.
Yeah, and there was a question to send a link to the scholarship. I think that would be a good idea indeed.
Absolutely, we can do that. I will pass over to Anna.
Great, thanks very much. I'm happy to be chairing the next session on monetary policy, transmission, and redistribution. I'm Anna Kovner from the Federal Reserve Bank of New York, where I lead the work we do that relates to financial stability. And without further ado, I will turn things over for the next 30 minutes to Alina Barsher, who is going to discuss her work on monetary policy and racial inequality.
Okay, thank you very much. Let me try to share my slides first of all. Is that working well for all of you? Okay.
We can see it. It is not, I don't think, full screen, but the slides are viewable.
But now.
Full screen
Okay,
now.
excellent. Okay, so yes, thank you very much, and thanks a lot to the organizers for including our paper in the program of this really amazing workshop. So the paper I will present today is about monetary policy and racial inequality, and it's joint work with Moritz Kuhn and Moritz Schularek from University of Bonn and Paul Wachtel from NYU. And since I recently started to work for a central bank, I need to emphasize that the views expressed here are only our own. So as you probably know, racial gaps in income and wealth are quite persistent in the United States, and actually even 50 years after the civil rights movement took place, these gaps are still really substantial. For example, in 2019, if you look at data from the Survey of Consumer Finances, you see that the median wealth gap stood at around 11%, which means that basically the median Black household had only 11% of the wealth of the median white household. And for income, the gap was a bit less pronounced, but still remarkable at around 58%. For a long time, however, macroeconomists and monetary policymakers have thought that these racial inequalities are more or less outside their purview. Yet, more recently, this perspective has changed a bit, and there has been an active discussion among central bankers to what extent central banks should pay attention to such inequalities across races in income and wealth, or even actively try to mitigate them. And against this background, it is very important to gain a deeper understanding of how monetary policy actually affects racial inequalities. So the goal of our paper is basically to fill this gap. And the way we do that is to estimate instrumental variable local projections, where we estimate the effects of monetary policy shocks on asset prices and the black-white unemployment gap over a 5-year horizon. And we use identified monetary policy shocks for that purpose. So we basically take them off the shelf. So we use the narrative shocks by Corbillon et al., which extend the famous Roma series, but we also use the Bernanke-Kartner 2005 and Gertler and Karadi 2015 high frequency shocks. And then after we estimated the effect of monetary policy shocks on asset prices and unemployment gaps, we link these estimates to microdata from the Survey of Consumer Finances, where we have information on household portfolios as well as employment for Black and white households. And this then allows us to directly compare the effects on portfolios and earnings of Black and white households. And what we find is that there is actually a trade-off. And the trade-off is between earnings and wealth inequality. So accommodative monetary policy shocks tend to lower unemployment and increase the labor income of marginal workers. This is also something which was discussed lively yesterday evening in the panel discussion of Isabel and Carmen and Minouche. So this is something which tends to reduce inequality between black and white households, because typically these marginal workers are more likely to be minority households. And we find that the black unemployment rate falls by around 0 percentage points more after a 100 basis point expansionary monetary policy shock than the one for white households, which translates into a relative average earnings gain of black over white households of around 97, like roughly $100. However, as also emphasized in the discussion yesterday evening, monetary policy does not only affect labor market outcomes, but it also has important effects on asset prices. And against this background, it is very important that black and white households actually have systematically different portfolios. So because of this, we actually find that there are largely heterogeneous balance sheets effects, where the average white household experiences a capital gain of around $25,000 after an expansionary monetary policy shock, whereas the average black household only experiences a gain of around $5,000. And what that means is that basically accommodative monetary policy shocks have indeed a tendency to reduce income or earnings inequality between black and white households, but at the same time, they actually increase wealth inequality. And yeah, very briefly to position our paper in the literature. So we mainly speak to 3 strands of the literature. First of all, the one on macro policies and racial inequalities very generally, and then the literature on monetary policy and heterogeneity, where many important contributions have been made also on the theoretical side with the Hank literature. And then finally, most closely related probably, the literature on the distributional effects of monetary policy, where very insightful work has been done, not just for the US, but also with data from Denmark and Sweden and Norway very recently. So before coming to the results, let me first say a few words on the data. Our macro data come from the Survey of Consumer Finances, which is representative at the household level. And what is very important in our context is that we have high quality information on wealth, because the SCF is actually oversampling very wealthy households. And our concept of wealth that we use is marketable wealth, so anything you could sell on the market, where we always mean, or I always mean net wealth if I say wealth. So basically we look at the sum of all assets and we subtract the sum of all debt. And for stock and bond holdings, we do not only consider direct holdings, but we also take into account indirect holdings, for example, via mutual funds, via your pension accounts, via investment savings accounts, trusts and annuities, and the like. And these positions we basically always split and attribute them to the respective appropriate stock and bond positions. Yes, and another important distinction is when I say income, I mean typically total household income from all sources. But when I say earnings, what I mean is specifically wage and salary income. So these are our macro data. And the macro data we use are pretty much standard series from the Federal Reserve, Standard & Poor's, the BLS, etc. So I guess I do not have to go into that much detail. So what's probably most important, we use the S&P 500 stock price index. We use the Case-Shiller repeat sales house price index. And then we use different yield series, corporate debt and treasury yields, which are obtained from the Federal Reserve. Okay, so let's first of all look at some stylized facts on racial income and wealth inequality. So in this table, we see a summary of the, first of all, average and then median positions for white and for black households for the most important asset class, and then we also have income information. And what I have emphasized here is, for example, the equity holdings. So we see that there is a pronounced gap between black and white households, both at the average and at the median. And this gap is particularly large for financial assets. So for equity, for example, basically the average white household holds more than 11 times as much as the average black household. And at the median, while the median white household still has $9,000 of stock holdings and $170,000 of housing wealth, the numbers for black households are simply zero. They don't have any at all. And this translates into these differences at the extensive margin. So the share of households with positive holdings of these respective assets, which you see here in the two columns on the right-hand side. So for example, for stocks, even if we take into account those indirectly held via pensions, for example, we have like a participation quota of almost 2/3 for white households, but only a bit more than 1/3 for black households. So these are really very stark differences, and these differences have actually been very persistent over time. So here we see the racial wealth ratio and income ratio. So basically the ratio of average black to white wealth and income, taken from the SCF Plus data set. What that is a data set which extends the modern SCF, which only starts in 1983 back to the 1950s. And so here we can go all the way back until 1950, and we basically see that today, more or less the racial wealth ratio is at similar levels as it was in the 1950s. There was a bit of an improvement in between, but today, basically we're back to the situation of the 1950s, and the same actually holds true for income. So these gaps are really very persistent over time. And a final slide on like the stylized facts. So here we see a graphical representation of the average household portfolio of a white and a black household respectively. And here we can already see where these differences that we will find in the end are coming from. So basically, if we look at white households, they have more bonds, they have more housing, and they also have more equity than black households. Whereas black households are rather invested in liquid assets, which typically only give you very low returns, obviously. Other financial assets would mostly be life insurances, and non-financial assets, which are mainly vehicles, so cars. And due to these very different portfolios of black and white households, also the effects of asset price changes will be very different for these two groups of households. To see this, we start by just doing some comparative statics, where we basically just impose price increases, which you can easily scale up and down. So here we look at the effect of a 10% increase in asset prices, and then you can just basically multiply by 2 if you want to have the effects of the 20%. And we see that the effects are much, much larger for white households than for black households, particularly for equity and for housing. So here on the left-hand side, we have the effects for each household, so average effects. And on the right-hand side, we have effects normalized by group income. And even if we basically like take affordability into account by normalizing by income, we still see very pronounced differences, although they are mitigated a bit, for example, for housing. And we do the same kind of exercise with respect to interest payments and interest income. So what we are seeing here are the effects of a 100 basis point reduction in interest rates over a 1-year horizon. And we first of all have the gain from a mortgage interest change, and then we have the loss from savings and bond interest changes, where basically the assumption is that all maturing deposit type assets and corporate and mortgage-backed bonds are reinvested at a new lower rate. And for this part, the assumption is that all fixed rate mortgages are refinanced. And then we can see that the effects in terms of basically saved mortgage payments are larger for white than for black households. if you look at the average effects relative to group income, it actually looks very similar, with very simply assume here like that everybody is refinancing and more or less optimally refinancing. But recent evidence shows actually that this is very likely not to be the case. So there's evidence that Black households have a lower propensity to refinance and therefore basically benefit from the gains of falling interest rates. So in practice, we can expect this gap to be even larger. Also for the mortgage interest rate changes. In terms of savings interest, the loss is a bit bigger for white households than for Black households, simply because they still have more liquid savings as well. But overall, they gain more in terms of basically like saved mortgage payments than they lose in terms of interest income on their deposits at the bank. But these are just comparative statics. So to get a bit of a better impression by how much monetary policy actually affects these asset prices, we then go to the PIVs. So what we do is we use these monetary policy shocks I mentioned earlier and estimate the effects of these shocks on asset prices and the unemployment gap, estimated from high-frequency macroeconomic data. And then we combine this with the low-frequency data from the SCF. And in the PIVs, the idea is basically to use the monetary policy shock measures as a proxy for the underlying structural shocks. And we consider a 100 basis point surprise reduction in the federal funds rate. For yields, we need a way to transform the yield effects into price effects, and we do that by simply applying duration estimates obtained from Bloomberg. And then we combine the estimated price changes with the portfolio data and with the employment data to have a way to gauge the portfolio and earnings effects on Black and white households. The regression looks like this. So in the first stage, we regress the change in the federal funds rate on the surprise component, which is proxied by either of the three shock measures, plus a set of controls. And then in the second step, we use the predicted value from the first stage and plug it in and then estimate the effects on our outcomes, for example, on stock prices and house prices for different horizons over a 5-year period at the monthly frequency. And this is what comes out of this exercise. So in the upper left panel, we see the effects on stock prices. And then here we have house prices, the treasury yield, and the effect on the unemployment gap for the three different shock measures. And while there are some differences, the broad picture is actually similar across shock series. So for stock prices, we see like a small decline in the beginning, but then we see a very pronounced increase, and it's actually fairly persistent. So we are like somewhere between 4 and 6% here. And for house prices, the effects are a bit smaller, like between 2 and 3%, and a bit less persistent, but still very substantial. For the treasury yields, we see somewhat, we see a bit of a decline, and depending on the shock series afterwards, an increase, here as well, but it's very delayed. But what's very clear is the effect on the unemployment gap, which is definitely reduced for all three types of shocks. And then we apply these price changes basically to the pre-existing portfolios of households in the SCF in 2019 and get the following picture. So on the left-hand side, we see the effects based on the Roma shocks, which are basically our main shock measure in the paper, but it looks pretty similar for the other two shock types. And the first takeaway is basically that we see much larger effects here again for white than for Black households at all horizons. And these are average effects. So they are very much influenced by equity effects, which is the darkest color here, and really accounts for the largest part of the overall effect. The bond effect is fairly small, but there's also a non-negligible contribution of housing. And on the right-hand side, we basically repeat the interest rate exercise and again see that white households benefit a bit more in terms of the gain from the mortgage interest change, but lose a bit more in terms of savings. And oh, here's actually the bonds missing in the label, but they're in. However, of course, wealth is very unequally distributed. And so we can also assume that the capital gains, which are based on these underlying wealth portfolios, are as well very unequally distributed. So what you can see here is a graph which has the wealth percentile on the x-axis and the percentage share of the total gains, so the total portfolio gains on the y-axis. So basically this is a Lorenz curve. And we can see that around 80% of the total gains accrue to households in like the top 5%. And around 50% of the gains accrue to households in the top 1% of our households. So the question is, of course, if we look at these effects at the mean, which we saw before, to what extent is this just driven by like the very top of the distribution, potentially like very large outliers at the top of the distribution? So we also looked at households around the median, which we can see here on the right-hand side. So around the median, what that means is we look at households between the 40th and the 60th percentile within each distribution, so the white and the black wealth distribution. And what we can first of all observe easily, because here we on purpose put it on like the same y-axis, is that the effects are much smaller, of course. But what is important to note is that they are still much larger for white than for black households. So even around the median, there's a very pronounced black-white gap. An important difference is that basically here, the effects are now much more heavily affected by housing than by stocks, because basically stock holdings are largely concentrated among households at the top of the distribution. But we saw before that basically households like at the median, black households at the median don't own any houses at all. So even like if you expand it a bit upwards and go to the 60th percentile, there's very little housing that these households actually own. And obviously, if you don't own any housing, you can also not benefit from capital gains in the housing market. And these portfolio effects, we then would like to contrast to the earnings effect. So what we do there is to focus on working age household heads from the SCF. Working age meaning households between 25 and 55, so they're like safely away from the retirement threshold, basically. And then we compute the earnings difference between black households who had versus who had not an unemployment experience over the past 12 months. And this is basically $28,700 roughly. So what we then do is to make a somewhat bold, but in any case, very conservative assumption. So we assume that all households who find employment, no matter whether they are black or white, receive the average earnings gain of a black household finding employment, which are these roughly $29,000. And we combine this with the estimated change in the unemployment gap from our LPIBs. And then finally, in the last step, we accumulate the effects because earnings are, of course, a flow and wealth is a stock. So we accumulate the effects over time to compare them to the portfolio or wealth effects. And in this slide, you can see the result. So even though the earnings effect is accumulating over time, it remains orders of magnitude smaller than the wealth effect. So here we have in light blue the relative earnings gain for black households, and in this gray blue color the relative capital gain for white households. So basically this is like white minus black, and this is black minus white. And we can see that it is really like orders of magnitude larger, though the wealth or capital gain effect than the earnings gain effect. And this remains so up to Horizon 5. And if we would like to put this a bit more into perspective, we can take estimates from the literature on the marginal propensity to consume out of wealth, which are typically something like 3 cents on the dollar. And if we take this estimate from the literature of 3 cents and multiply it with the relative average capital gain for white households, which was 25,000 minus 5,000, so 20,000, then we get additional consumption expenditures of around $600. The maximum relative earnings effect, however, occurs with the Roma shocks at Horizon 3, so after 3 years, and is a bit less than $100. So it's actually 6 times smaller. And based on these estimates, we conclude that expansionary monetary policy shocks actually seem to improve the labor market situation more for Black households, at least based on the strong assumptions we're making. But even if there's a positive earnings effect, it is still dwarfed by the magnitude of the portfolio effects. So one last thing I would like to mention before concluding is that we, of course, look at the effects of transitory shocks, but this does not mean that these effects would just wash out. On the contrary, even transitory shocks can have very long-term and persistent effects. So first of all, many of our impulse responses that we estimate, for example, for the stock prices are very persistent in the first place. But even if asset prices were just changing temporarily, this could have lasting effects. So there are various things one could think of. First of all, asset price changes induce wealth effects. And basically, once you have realized the capital gain, you have that money in your hands and it stays. And there's an important interaction between life cycle trading motives. So for example, if the value of your house increases, but you want to move to another house, and then you have to pay more for the new house as well, then you don't gain much. But if you actually plan to sell very soon, then it is very good for you, of course, if the value of your house has increased. And there are systematic differences between Black and white households in demographics and employment or unemployment experiences, which can actually induce systematically different propensities to buy or sell these assets that we talked about. And two further important considerations are about collateral constraints and mortgage refinancing. So first of all, if asset prices increase, especially if house prices increase, this relaxes borrowing constraints. And this is already quite powerful, even if the asset prices just increase for a relatively short period, given that these constraints do only need to bind upon origination of the mortgage and not necessarily thereafter. And then finally, in a country like the US, where you have mostly fixed rate mortgages, the opportunity to refinance to a lower rate can actually induce very persistent effects, given that if you refinance, you just basically lock in a lower interest rate for the next foreseeable future. So yeah, let me wrap up. We find that monetary policy shocks differentially affect the earnings and wealth of Black as opposed to white households, where Black households tend to reap larger benefits from accommodative policy shocks in terms of employment and earnings, whereas white households gain much more in terms of wealth. And this is mainly because they have just much more housing and equity holdings. And overall, the reduction in the earnings gap is dwarfed by the increase in the wealth gap, which suggests that there's a trade-off for monetary policymakers who might want to reduce these racial inequalities, because policies which might reduce the income differences at the same time exacerbate the wealth differences. So while we believe that racial inequalities are actually a first-order objective for economic policy, we are somewhat skeptical that the tools that a central banker has at hand are the right ones to address this challenge. So yeah, this is it from my side. Thank you very much.
Thank you,
and I'm looking forward to the discussion. And I hope I stayed more or less on time.
I mean, and thank you for your timeliness. because I've yet to see in an online context a very good way to flag the speaker's attention that they're running out of time. And so you did a great job at staying on time. I will turn things over to Anna Rogantini-Pico, who will offer a discussion. I will just suggest, Alina, that you take a browse and look at some of the questions in the chat. And we have 15 minutes for Q&A at the end. And maybe we could raise some of those questions verbally and have a little bit of a discussion on that as I kind of kick off to the Q&A rather than typing back in the chat. Which can be a little distracting while Anna's offering her discussion, which I'm sure you're also going to want to think hard about her comments. So I will turn things over to Anna. Right?
Yes. Can you hear me well?
Yes.
Perfect. So thanks so much for letting me discuss this paper, and thanks especially to the organizers for this really awesome conference. I wanted to say that it's really great, and it's especially important for people like Alina and myself who are junior at the beginning of our career, and with the pandemic we found ourselves a bit constrained in the way we could expand our network. So events like this one are really amazing opportunities. So thanks so much. And then back to the paper of Alina. This is a really important topic that they're looking at. So let me start by putting the paper into the broader context of the literature. Alina has already done so a little bit. So there's an exploding literature looking at income and wealth inequality, of course, because we notice that inequality in income and wealth is very persistent and is increasing at times. And this growing literature comes both on the theoretical side and on the empirical side. On the theoretical side, now there's a growing Hank literature which shows how micro-level heterogeneities are important drivers of aggregate dynamics, and also the other way around, how aggregate dynamics might affect in a different ways people located at different points of the income or wealth distribution. Along with this theoretical literature, there's also growing evidence on this heterogeneity, looking both at unconditional estimates, so how individual income is correlated to aggregate one. And then there is more specifically like a strand of the literature looking at monetary policy transmission, both using survey data and using administrative data, mainly from the Nordic countries. So in this context, the paper by Alina focuses on a very specific dimension, which is racial inequality, and in particular, Black versus white. And until recently, racial inequality was a bit outside of the central banker's purview. But in recent times, central bankers started to have more focus on that, and how the Atlanta Fed president put it, the Federal Reserve, and here I'm quoting, can play an important role in helping to reduce racial inequalities and bring about a more inclusive economy. So now there are, so this paper studies the impact of monetary policy on racial inequality, and in particular focuses on two channels. One is the earnings channel. So the idea that accommodative monetary policy helps bringing people outside of unemployment and flowing from unemployment to employment. And since this margin it seems to affect more Black people, this channel is likely to decrease racial inequality in income. The other channel instead goes through portfolio channel, which goes through asset prices and interest rate changes. And in this case, as Alina showed, because white households are disproportionately owning wealth compared to Black households, this channel is actually increasing racial inequality between Black and white. So these two channels potentially have opposite effects on racial inequality. And so what the paper does is, using local projection methods, establishing two results. One, that larger employment gains, there are larger employment gains from Black households as a consequence of loosening in monetary policy. So this reduces income inequality. On the other hand, there are larger wealth gains for white households, thanks to the portfolio channel. And what is important is that the second effect is at least one order of magnitude bigger than the first one. So it seems that a loosening in monetary policy disproportionately affects wealth of white households than income of Black households. Okay, but so let me give you some thoughts about the paper. So the first comment that I have is more of a suggestion, and it suggests to exploit a little more the heterogeneity in the data that you have. First of all, to add a bit more information on the SCF. I couldn't really find in the paper like more info on demographic characteristics, which I think could be really relevant. I saw there were some comments in the chat as well about thinking how to combine race with other demographic characteristics in driving this income and wealth inequality. But let me go in steps. So first, I noticed that there is a third category, non-Black and non-white. So I was wondering why you haven't looked at it, whether there is a specific reason, or whether you could, in fact, look at also that group of people. The second is that there is evidence of divergence along wealth and income distribution, regardless of race. So I was thinking that it could be interesting to interact the two things. So race and income distribution, or race and wealth distribution, to explore whether this inequality has increased not only across groups, but also within groups. And whether you could control for other demographic characteristics that could drive the difference that you find between Black and white. And the third, you have a very nice discussion on the persistent effects of monetary policy, going through, so even if shocks are temporary, they can have like a long run effect through wealth effects, through the life cycle, the fact that people take decisions not very frequently and at different points in their life cycle, and this might lock in some of the monetary policy effects, and as well borrowing constraints. So I was thinking whether you have evidence of differences between Black and whites along these dimensions. So whether Black people are more subject to borrowing constraints, and therefore like a loosening monetary policy would release the collateral for them more than for white, or vice versa, or whether life cycle might play a different role in these two groups of people. So yeah, the suggestion would be to try to explore more the heterogeneity that you have in the data. The second comment concerns your analysis on earnings and the labor market. So you focus on Black-white unemployment gap, and from your empirical analysis, it doesn't seem that you find a very big effect. In the presentation, like you didn't show the confidence bands, but apart, I think from the Romer and Romer shock, you actually get that the unemployment gap decreases significantly, but for the other shock series that you look at, this is not the case. And also, if you use instead the VAR approach, you don't find a very big effect. But nevertheless, it could be that that monetary policy affects the labor margin, but along other dimensions. And what I was thinking is instead of looking only at the extensive margin, you could in fact think that there is an effect on hours and wages. So maybe you could try to explore these margins. Because it could be that, for example, Black people are more marginally attached to the labor market, so they do have a job, but it's temporary, and the loosening in monetary policy might increase the number of hours that they work. So I think this could be a really nice addition if you could do that. And yeah, exactly, both in the aggregate, so you could look at the effects of monetary policy on wages and hours, but also using the microdata. Of course, I don't know how much you have, whether you can do this decomposition between wages and hours. If so, I think it would be super nice. Okay, I still have a bit of time. 5 minutes, yeah. Okay, so the next comment concerns the divergent trends in wealth to income ratios. I think this plot that you showed is very interesting. So if we look at the plot on the right-hand side, the B, we see that this wealth to income ratio co-moves more or less until the 90s between the white and the Black, but then it starts diverging from the 90s onwards, and especially like it's probably because it disproportionately grows for the white group. So I think it would be very nice if you could try to dig a bit deeper into this trend and explore the drivers. For example, whether is the composition of wealth that diverges between the Black and white, meaning that maybe the white people have their wealth invested in a type of asset which shoots up, while the Black don't. I mean, I know you have like you show the composition for the across assets for the wave of the 2019 of the survey, but maybe you could, I don't know if you have the same for the 90s, then you could compare the composition of across asset classes. Could also be that like the sensitivity of each asset class has changed in a differential way for Black and white. Maybe the type of like the type of houses that Black and white have is different, and their price is the sensitivity of their prices is different. So I think it would be a good addition if you manage to dig a bit deeper into this divergence in the trends. And finally, I have some more reflections on the estimated effects. So you focus on comparing the portfolio effects, in particular the gain, which is like a gain in the stock of wealth, versus the earnings effect, which is instead a flow. So I was thinking, is this the relevant comparison? Probably the relevant comparison would be with the realized capital gains and realized interest, earnings, and expenses, while when you look at the stock of wealth is still unrealized. So if you can, why not to compare labor income to capital income more directly? Instead, I mean, you do something like you do kind of the opposite exercise. So you try to look at earnings over five years to make it more like to account for how much this could last. But I think it would be more interesting to do the other way around. And then you look at the effects of interest rate changes as estimated over a long time horizon. But then you look at the wealth income in 2019 when interest rates are at the effective lower bound. So it's a bit hard to believe that there are strong effects in 2019. Of course, you can think that this is a snapshot of wealth and income, and maybe it was similar between black and white, like the composition previously, like before the CLB period. So that's fine, but I don't know, that's just a thought. Maybe you could comment on this a bit more in the paper. And yes, and then the very last thing then related to this, maybe you could look at other types of shocks and not just the monetary policy shocks, which now are very constrained. Maybe you could look at productivity changes or fiscal transfers. Okay, so I think this is a very topical paper given the increasing evidence in inequality across several dimensions. It focuses on a very specific one, which is racial inequality, and combines it with monetary policy. My suggestions are to exploit more the heterogeneity in the data that you have. In particular, you could interact race with income and wealth heterogeneity. You could understand a bit better the drivers of the divergence in the wealth to income ratio from the 90s. I think you could explore extensive versus intensive margin in labor income. This would be incredibly interesting to me. And then you can think about other shocks, but than monetary policy. But thanks so much, and congratulations for the very nice paper.
Great, thanks very much. Alina, why don't you come back once Anna stops sharing her screen, and if you wanted to offer a quick response, maybe touching on what was mentioned both in the discussion and in the chat as relates to some of the other covariates such as income and education. And then I see hands from Sebnen and Anusha and some questions in the chat. And so maybe I'll just alternate between calling on folks with their hands raised and questions in the chat, and turn things over to Alina.
Okay. First of all, thanks a lot, Anna, for the very helpful and detailed discussion. So yeah, I've tried to take a few notes to be able to answer your like to some of the points you were raising. So like, for example, one thing you were mentioning, why we look at black and white households and not, for example, Hispanic or Asian or Latinx households. We were basically inspired by the policy discussion in the United States, which was mainly focusing on black-white differences, and then also basically this other group. I mean, it comprises like quite different ethnic minorities, and we wouldn't have enough observations to look at each of them separately, and also potentially the composition of this group has changed over time. So we thought it's basically like cleanest to just look at black and white households. Inequality within the two groups is actually a very interesting aspect, which we haven't explored so far, but that might be something we would want to look at, and we can definitely do it with our data. Then you were mentioning the point how many black and white households are actually at, for example, a certain point in the life cycle, which would suggest certain trading motives, or how many are actually borrowing constrained. I mean, being at a certain point in the life cycle, we can definitely see that in our data. Borrowing constraint is a bit harder. I would very much assume that there are systematic differences. It might be, I mean, it might depend on what you're exactly looking at, to what extent you can tease it out of the data, but we can definitely try. And yeah, the suggestion to look at hours and wages is actually a very good one. We've thought a bit about this as well, and we'll see what we can do. Basically, we would need sufficiently high frequency information on either hours or wages or both. But potentially we can find that like maybe in the CPS. So this is something we will try to do if we can. Yeah, the divergence in the wealth to income ratios after the 80s or 90s, as you suggested, this is in all likelihood largely driven by basically the portfolio composition, because this is when housing markets and also stock markets were taking off, and we saw that actually white households just have a lot more housing and a lot more stock holdings than black households, so they could basically reap enormous capital gains at this period, which will probably be a large driver of this increase in the wealth to income ratios. I mean, it's not so much the focus of this paper. We just showed it as like, yeah, some additional motivating evidence, also drawing on the long run data. But it's not directly related to the monetary policy effects. But my co-authors are also working on like the historical evolution of black and white wealth. So I would assume, I don't know exactly what's in their paper, but I would assume you find it in there. Yes, and yeah, to what extent capital gains are actually realized, that's a tricky question. We were looking a bit at information on dividend income in the SCF, but reported dividend income is actually quite small, and then also the effects we estimate at the macro level aren't super big. So this was these were really small effects, and also like concentrated at the very top of the distribution. For housing, for example, we don't know realized capital gains. So what we basically do is to take this like off-the-shelf estimate for the marginal propensity to consume out of wealth gains, and then have this like rough number of about $600. This is like, yeah, I mean, a back of the envelope calculation, but at least it gives you an idea that, you know, even if you apply this, it's still much larger than the earnings effect. And yeah, I mean, we were using the data from 2019 because they are the most recent, but we could, of course, do the same exercise for like basically any other year of the SCF.
Thanks. Why don't we, I think we have about 8 minutes left. Let me turn to Subnan, who's on the left of my screen, suggesting she might have raised her hand first.
Yes. Okay, so great paper and discussion. I just want to make a suggestion to the authors highlighting this literature on bank lending, channel of monetary policy transmission, and racial bias there. So there are a lot of papers that says, you know, that I mean, looking before COVID and during COVID, using the PPP loans, banks are racially biased. So this kind of, and this is exactly done based on controlling, you know, these guys are, you know, black households are poor, they have low education, they have low wealth. After all that, I mean, so it's very, very detailed, because with PPP you can do a lot. And they say it is, you know, banks are rational. I mean, but that's huge, right? Because then monetary policy can do something. If it is going through the intermediary sector, then they, you know, monetary policy have an avenue to do something. So I was just wondering if you look at that and relate that. Very, very good paper, very good discussion.
Thanks a lot. So yeah, should we collect the questions or?
Yeah, why don't we collect a few questions,
okay,
and then you can respond, and some that are comments we can just don't feel a need to respond to. Anusha, and then Veronica, and then I'll just read from the chat Karen's question about since house price responses are likely different in different areas, do you have information on how the two groups might be differently affected by this? Do the two groups have different leverage when you think about how changes in house prices could affect the two groups differently? And then I'll call in Anusha and then Veronica.
So fascinating paper. I really enjoyed it. And it sort of reminds me of this old NPR story about that came out of the Federal Reserve Bank of Boston. Anna Patricia Munoz did the study where they showed that the median net worth of families in the greater Boston area, if you looked at white households, it was $250,000. And if you looked at Black households, it was $8. And so one question that sort of came up was, distinguishing between non-immigrant Black families and immigrant Black families. And I'm just wondering if you can do that with your data, because there are differences depending on whether these are non-immigrant families or not. And the second question sort of relates back to the conversation yesterday. Given that you find these offsetting sort of effects in terms of what happens to income inequality versus wealth inequality, what is it that monetary policy can do about this, right? And it sort of relates to a broader question of asset price inflation, sort of exacerbating wealth gaps. Thanks.
Veronica?
Yes, hi. Very nice paper. And I just have two quick questions. I mean, there is some in the chat that you can read, but one is, I haven't read the paper, of course, so maybe it's in there, but it would be nice to connect a little bit more on the literature, not only on monetary policy shock. For example, I don't know, your first result is about the effect on unemployment, that if you have an expansionary, a positive demand shock, basically unemployment reduces more for the Black. I don't know if this is a result that is already somewhere in the literature in terms of demand shock. If not, I mean, it's an interesting result to highlight per se. If yes, it's okay. I mean, you're just measuring that effect in contrast to the others, so it's still nice, but it would be nice to clarify that. And the other thing is that it would be useful to, I don't know if you can do that, but to see if there are differences if the shock is asymmetric. So if you have a positive versus a negative shock, if the relative size of these components are different and potentially change the sign or not, because or also the size of the shock may matters for that. I don't know if you can do that.
Yeah. Okay. Thanks a lot. So first question was on a bank lending channel and racial bias, right? So yeah, I definitely assume that this affects a lot of what we are seeing. That's, that there is discrimination in lending and therefore access to home ownership and has been, and also discrimination in labor markets, which has basically taken place over decades and will surely factor into the results that we get. Because, I mean, like one question which we also tend to receive a lot is basically, okay, but is this like really something about Black and white per se? If these households had the same characteristics, wouldn't they be very similar? And yes, they would be, but they do not have the same characteristics. They do not have the same portfolios, and this comes from somewhere. Of course, it's very hard to pin down from where exactly, but basically, yeah, decades of discrimination will have affected this for sure. And ongoing discrimination even today is continuing to affect these outcomes, because yeah, if you can't get access to mortgage credit, for example, you have a very hard time accumulating housing assets and then benefiting from capital gains in the housing market. What else? So whether we can distinguish between immigrant and non-immigrant Black households, that's actually very interesting. I'm not sure if we can do this with our data. I will need to check. I'm not sure. I mean, the SCF is a repeated cross-section, so they would need to specifically ask about whether somebody is an immigrant or not, and I'm not sure if they do, but I will check. And then, there was a question about differences across areas that would potentially be very interesting indeed. But we don't have location information in the SCF, unfortunately, due to this oversampling of wealthy households. So basically, they are concerned that you would be able to identify households if they gave you location information. So we don't observe this. But in general, yes, this might contribute to even more pronounced gaps potentially if maybe like white households tend to live in richer areas where house prices increase even more, but this remains speculative, so I don't know it. But in general, we completely abstract from heterogeneous returns. I mean, there's also a lot of evidence in the recent literature that, for example, returns are increasing in wealth. So if white households start with more wealth in the first place, maybe they also have higher returns than black households, which would lead to even more pronounced gaps. But given that we basically apply the same price series to everyone, we would in that case like underestimate the gap. And yeah, the literature on black and white employment, we have more on that in the paper. And I mean, this is not entirely new what we're doing here. So it actually meshes nicely with previous results by Carpenter and Rogers, for example, where we have like more on this in the paper. And yeah, asymmetric shocks we have not explored yet, but I think it's something we could do. I hope I haven't forgotten anything.
No, that marks time in any case. So Helen had a comment in the chat, which you can read and follow up on at your leisure. And I will be a fierce timekeeper here. And it's time to move to the next paper on risk-taking and monetary policy transmission, looking at evidence from loans to SMEs and large firms. So I'll hand things over to Sebnem. I can see your slides and you are now in full screen mode. So take it away.
Okay, great. Thank you so much for the organizers for putting our paper in the program. And this is an amazing conference. Let me just first say that, a great organization. And you see that I put the pink, we are in, so in pink. I want to highlight that point. So yeah, so congratulations and kudos to everybody involved with the organization of this conference. So this paper is joined with Cecilia Caglio and Matt Darst, and usual disclaimer applies. They're at the Fed and they are here so they can answer questions in the chat. Okay, so let me start by telling you what the paper is about. So the paper is about trying to understand monetary policy transmission under heterogeneity. And it is going to be an empirical paper. And there are many of you who work on this topic here. So I don't have time to go through a literature slide, but we go through your work in the paper. And we try to link as much as we can to the existing literature. Our reading is most of the existing literature for monetary policy transmission is under heterogeneity is on the consumption side. Veronica's work, Helen's, Luke, I mean, like many of you work on this, try to understand heterogeneity in MPCs and financial frictions and, how it works through the consumption channel. So we would like to look at the investment and employment side through the firm channel. Okay, so it is going to be very much focused on that. So we would like to understand when monetary policy changes, what is the key heterogeneity in the firm credit market that somehow translates to investment and employment, telling us something about the monetary policy effectiveness. Okay, so that's what we want to do in the paper. It is going to be an empirical paper, although at the end I'm going to try to use a very simple, simplified framework to interpret some of the results. And when we do this, again, focusing solely on this, much narrower firm credit market, what is the key heterogeneity we are going to tell you about? So the key heterogeneity is going to be size of the firm and type of collateral. They are going to interact with each other, but they are going to capture different things. So hopefully this will be clear during the presentation. Okay. So in terms of where we fit on the firm and bank side of the literature, so there are several theoretical papers actually that argues that the power of monetary policy, is going to depend on the heterogeneity on those margins, on the firm and the bank side. And these models are, very detailed, working of these trade-offs that can happen. So what do I mean by that? On the firm side, so there is going to be a trade-off for the policymaker stimulating the economy in the short run. I mean, I'm I'm going to talk a lot about expansionary monetary policy because that's the period we will be working with. So you do expansionary monetary policy to stimulate the economy. So you do want firms to borrow. Okay, you want the credit flowing to the firms. But if the credit goes to the wrong firms, we were talking a little bit about this yesterday, the zombie firms, low productivity, likely to default, then you are facing a trade-off in terms of long-run growth. Okay, so that's one trade-off. On the financial side, it is about financial stability. Helen has written extensively about that. So here the idea is if banks are taking risks during these too long interest rate periods, ZLB, then how should we be thinking about the leverage regulation? Are the banks really after the extra customer, or the banks are trying to literally go out and find the risky customer and lend to the risky firms? Okay, so that's going to, of course, tell us something about leverage regulation. So there is an empirical literature tries to test these micro foundations and the implications of these models, but mostly this literature, again, I'm talking about the US, most of this literature uses publicly listed firm data from the US, okay? The problem there is, of course, these models speak for the aggregate economy, right? So we would like to understand the effect of heterogeneity, but on the aggregate economy in terms of monetary policy transmission. But when you go and use publicly listed firm data, you are not going to capture the aggregate economy, right? So listed firms are going to account 26% of domestic US employment and 44% of domestic gross US output. And this explains why we have a lot of mixed results in this literature. If you look at this literature focusing on the US, you will have papers showing you small firms respond more to monetary policy shocks, or small firms respond less to monetary policy shocks. So there are going to be papers that tell you if there's any difference between small and large firms, that can be due to financial frictions. You are also going to have papers saying, it's not going to be due to financial friction, it's going to be other things. We are going to argue that most of these mixed results in the literature comes from relying on non-representative data sets. So what we would like to do in the paper is, and this is going to be our contribution, use first-time supervisory administrative data for US for a more representative sample of the US economy. Okay, let me tell you about the data because it is going to be important. And then I'm going to go to result. Hopefully I will finish in 30 minutes. So what is the data? So data is the new supervisory data known as Y14 of Federal Reserve. This is supervisory data on bank lending. So it is collected as part of the Federal Reserve capital assessment and stress testing exercise after the Lehman collapse as part of the Dodd-Frank Act. And this is collected from bank holding companies with total consolidated assets above 50 billion. And the threshold raised to 100 billion in 2019. So the data is basically the closest you will get to a credit registry in the United States. It is firm bank loan quarter level with a reporting threshold of 1 million. So as a firm, you go and borrow 1 million and up from a bank, then you are in the data set. Okay, that's how we are going to observe you. You will observe contractual terms and firm balance sheet items because firms report to the banks report to the Federal Reserve. It is going to cover all sectors, so that will be very good in terms of it's not just a manufacturing database. The caveat is, of course, it's not going to be a huge time series dimension because the data is going to start in 2012, Q3, it is quarterly. It is real time. I mean, you can see the data now, but we are going to stop at the end of 2019 on purpose because we do not want to do a COVID paper. So COVID is going to be out of this paper. We are going to have almost 4 million loan observations for over 150,000 companies. And most of our companies are going to be SMEs, small, medium enterprises, because they are going to have assets less than 10 million. Okay. So the coverage, so we are not going to have every single bank, of course, because you have to be part of this CEPR exercise. That means you're a systemically important bank, right? We are going to cover basically 85% of the total asset in the banking sector in the US. And even more importantly, we are going to cover 70% of the all CNI lending, okay, commercial industrial lending. So whatever we are missing, that 30% we are missing is going to be from a small local bank to the firm. So that's part we are not going to have, of course, because those banks do not report as part of this regulation. Still, this is going to be a much more representative data set. First time you have supervisory data on private firms financing. So we are going to be more representative compared to all the other data sets we use in the United States, such as Compistat, BioScan, Capital, like the Small Business Finance Survey, and basically all the data sets that we have been working in the last 2 decades. So these firms, Y14 firms, are going to account 65% of the entire US corporate sector debt and 78% of the entire aggregate US gross output. Okay, and when I say SME, the official definition of a small medium enterprise in the US is firms less than 500 employees. So I want to highlight that because this is less than 250 employees in Europe. But then there's also sales and asset definition, which is sales less than 50 million and assets less than 12 million. So we will be using those definitions too. But basically, what SBA and Census tell us, these firms in the United States, first of all, they are 99% of the firms. So 99% of the firms in number in the United States are SMEs, and they cover 52% of private sector employment, 48% of private sector output, and even higher when you bring the government sector. Okay. So let me try to link what you have known so far in terms of US corporate debt from the flow of funds data to what we learn now new from the Y14 data. If you go to the flow of funds data and you want to understand the corporate debt, the non-financial corporate sector debt, so there are two series you can look at, right? So non-financial corporate businesses and non-financial businesses. If you go to the non-financial corporate businesses, this is the figure you see on the left, and you say, okay, I want to understand the share of bank debt, bond market debt, and other fintech stuff on the balance sheet of these firms, and you plot that, you see an overwhelming proportion of this black line, market debt. So basically 60% of the debt of the non-financial corporates in the US is market debt. What is that? That's the bond. Okay, that's the bond market narrative that we all know very well in the US, and this kind of a narrative that, oh, US is very much bond-based, stock-based, and Europe is more bank-based. Okay, so the bank debt and the non-bank debt is going to be much lower. If you go to the non-financial business series in the flow of funds, you are going to get a little bit different picture. Actually, that market debt is going to crash now to 40%. Bank debt, the purple line, is going to increase to 30%, and non-bank debt is going to be similar. What is the difference between these two figures and non-financial corporate business and non-financial business? The left, non-financial corporate business, of course, all the large guys, all the listed CompuStat firms, plus large CNS corporations. Non-financial business have all the other SMEs. So that already tells you that it is going to be very important to capture the debt of the small firms. If you go to Y14 data, here I'm going to show you only the private firms, because this is the new observation we have from the Y14 data, and say, okay, let me look at the share of bank debt in the entire debt of this Y14 firm. And let me separate them by size, small, medium, and large. So small is less than the 25th percentile asset distribution, large is more than the 75th. If you look at the largest private firms in Y14, so this is the bottom dot dash pink line, you match the narrative of the flow of funds, right? The large firms, bank debt is going to be around 30%. The rest will be obtained from the bond market. But when you go to the SMEs, smaller firms, you know, in the distribution less than the 75th percentile and less than the 25th, so very small, their entire balance sheet debt is going to be bank debt. And this is actually the commitment. So they are actually what they are using. So, sorry, utilizations. If you look at the commitments, this is going to be even starker. So the entire debt is going to be from the banks when you look at medium-sized and small-sized private firms in the United States. Okay. And also, when you look at the entire Y14, you know, you are going to get a more representative US firm sample. The liabilities of these firms are going to account over 60% of the flow of funds, and publicly listed firms is going to be much less so. And gross output and sales on the right, you see that the pink are the Y14 firms. You are almost up to 80% of covering the real economic activity in the US, whereas publicly listed firms are going to cover much less. Okay, all right. Now I told you that, you know, this is a very good data set to cover a more representative set of firms in the US and the aggregate US economy. I would like to tell you a little bit about the different financing condition of these private firms, small firms versus large public listed firms. If you just start with the interest rate, just very simple, you know, how much these guys pay when they borrow, a medium private firm shown here on the left with the pink is going to be paid much higher than a medium public firm. And on the right here, I'm showing the share of the debt that is collateralized. And if you look at, again, the medium pink, the pink solid line, that will be the medium private, and the purple solid line will be the medium public, you will see a big difference, right? Almost all of the debt is collateralized if you're a private firm. And if you're a small private firm, the dash pink line, you are collateralizing everything. Whereas in the public listed sample, you basically borrow without collateralizing anything. And even you're a small public firm, still more than half of your borrowing is not going to be collateralized. Okay, so this is going to be very important for our result, especially when we start looking at the type of that collateral. So very nice feature of the Y14 data set is observing all margins of the loan contract, right? You know how much you borrow, you know how much you pay, you know your individual spread, and on top of that, you know the pledge collateral. You know what is pledge at the time of the borrowing for that borrower. So I'm going to show you in a color-coded slide. So what you see in this slide is the entire firm size distribution in the United States. The top 3 boxes will be the private firms. The bottom 3 boxes will be the public firms. So the top left, you start with small private firm, and the bottom right, you end up with large publicly listed firm, Amazon's and Google's of the firm. And then what we plot is the share of the debt collateralized by X, okay? So each color is going to be a different type of collateral. Just by looking at the colors, you see that, you know, the light blue is very dominant for small private firms, and that light blue becomes dark blue when you go to large public firms. What is that? Dark blue is unsecured lending, okay? So this is just, again, shows that large publicly listed firms, they just borrow unsecured. And the light blue is collateral that is based on your earnings and operations. So this will be blanket lien, account receivable, and inventory, okay? So that says securing financing to a firm size is going to be, if you're really small, it's going to be all about your earnings and operations. If you're large, you don't even have to secure it. Now, the orange is the standard collateral constraint we write down, and how we think in the literature, which is the asset-based collateral. That would be the real estate, fixed assets, and so forth, okay? Now, when you say SMEs, of course, there are large private firms. So let's go and focus the SMEs within that private firms. That is this top pink box, small and medium private firms. You see that they are largely going to be borrowing based on their earnings and operations, okay? Account receivable, inventory, and blanket lien. Now, there's already work that tells us that there might be important differences in financial constraint, and earning-based, cash flow-based constraints can be more important than the asset-based. This is the work by Lin and Ma and Kermani and Ma. They work actually with the publicly listed firm data set, and they work through estimating the liquidation value of the debt, not by looking at the observed pledge collateral. So what we are saying here is like, okay, looking at a completely different data set by looking at actual collateral, what they were saying is even more true for SMEs, and actually that's going to have macroeconomic implications because these constraints are going to be true for a set of firms that will account a large part of employment analysis. And there's also some work that tries to incorporate these type of constraints into macro models, like Drehel and Greenwald will be some examples. Okay, so how am I going to map this heterogeneity in the credit market to monetary policy transmission? So far, what did I tell you? I told you that private firms in the US, especially SMEs, rely on bank credit. Their debt is going to be entirely from bank. And when accessing bank credit, these private firms and SMEs are going to be facing different terms. Okay, they are going to face higher interest, and they have to use collateral. Okay, so they are financial constrained that they have to definitely use collateral, but they use a very different type of collateral than what we think. So they don't use fixed asset mostly, but they use a collateral that is going to be based on their earnings. How monetary policy is going to transmit through these margins differentially, or if at all? We do a lot in the paper, but this is, I have limited time, so I'm just going to show you two econometric specifications we do. The first one is going to be about identifying from varying from credit demand over time when monetary policy changes, okay? So basically, what we are going to aggregate these loans. There are multiple loans between firms and banks, and firms borrow from different banks. So we are going to aggregate them to the firm bank pair quarter level, okay? And we'll use a firm bank fixed effect to control the relationship, and bank quarter fixed effect to control the credit supply fluctuation, the lending channel with the over time. Then we interact with this quarterly monetary policy surprise shock with a firm leverage then. So the question is, okay, so if monetary policy is easy, this goes down, is it going to be the case that firm with high leverage is going to have higher demand for credit, and if they are going to pay a higher spread on that credit? Okay, so we are going to use both loan amount and loan spread on the left-hand side, both quantity and the price. And then we go one step further down in granularity, and we are going to run a loan-level regression. So we are not going to aggregate your multiple loans between these pairs. We are going to use each loan, and we will use a firm bank quarter fixed effect, which will help us a lot about these non-random matching between firms and the bank. So I'm literally going to look at, my firm and Veronica's bank, and multiple loans between my firm and Veronica's bank. Okay, and then I will like, okay, is it going to be any differences first normal times based on the collateral that secures that loan in terms of my amount and my price I'm paying on that loan, and what happens with this relationship when monetary policy becomes easy, okay? So what is this monetary policy business here? Monetary policy Q, we are going to do exactly what the literature does here. So we are going to use high frequency methodology around FOMC announcement. So these are every 6 weeks. We need a quarterly variable. We are going to aggregate it to a quarterly frequency, exactly as in the autonomous Winberry econometric effect. Okay, so we are not doing anything differently. Of course, you know, you would say, well, but aren't you working with, you know, small surprises? I mean, you would be right. This is the ZLB period, right? That's actually the only negative thing about this data is, unfortunately, we cannot go before 2012. That's what it is. So this is the ZLB period. These surprises are going to be small. Okay, so this is the autonomous Winberry way of you know, aggregating this to quarter level. The largest thing is going to be 40 basis point, and most of the period you are going to have an expansionary stance of the monetary policy. Okay, but this is what we are going to be working with. All right, let me show you the benchmark baseline results. So I'm going to show you all tables are going to be structured like that: quantities, quantity of credit, and then the price. So here, the first 3 columns is the quantity, amount of the credit you are getting. And then I'm going to first show you all firms. Then I will separate private firm and the public firms to show you how different results between the private US firms and public firms. And the last 3 columns is going to be this price, which is of course a loan spread, because the safe rate is going to be soaked by the time fixed effect. So that's the spread, the price the firm is paying. And again, I'm going to show you all firms, private and public. So the key result here, if you look at this pink box in all firm result, high leverage firms are going to borrow more when monetary policy is expansionary. Okay, expansionary surprise, this will go down. It's a negative coefficient. So that means your credit will go up. Okay, so there's more borrowing. And if you look at the same all firm result here, column 4 on the price side, negative coefficient, a higher price. So high leverage firms borrowing more at a higher price, at a higher spread during expansionary monetary policy. When I look at the private-public decomposition, nothing going on the public side. All the results are coming from the private firm side, both the quantity result and the price result. This is the average effect. We know, we just saw this in the previous paper, and we know from this literature that these surprises can have persistent effects. So when I do the local projection, again, exactly as done in the literature, what I see that there is going to be this persistent effect of expansionary monetary policy increasing the credit and the spread, or here it is easier to see a contraction of monetary policy decreasing the credit and decreasing the spread over 10 quarters, okay? Over 10 quarters, you see the effect. Of course, what is important for us is this is driven by leverage firm. Here, we are plotting the interaction term that the leverage firms drive this result, and not just any leverage firm, high leverage private firms. In fact, when you look at the high leverage public firms, the right figure here, blue, the effect goes exactly opposite. Here it is insignificant, but when you use other measures of leverage, this is going to be actually significant. So the leverage private firm and leverage public firm is going to respond exactly the opposite way to the expansion of monetary policy or contraction of monetary policy. But most of our monetary policy surprises here are expansionary because of the period we are working with. The same on the spread. The spread response are also going to be driven by high leverage private firms and not by high leverage public. Okay, and it is persistent over 10 quarters. Why is that? Why this is happening? So what is the story here? The story is going to have a lot to do with the type of the collateral you are pledging. Remember those color-coded figure. Now I'm going to bring that color-coded heterogeneity in the type of collateral to these regressions. First, I'm going to show you an extensive margin regression that is just collateralizing a loan or not. Okay, so this collateralized variable here you see is just a dummy 0 1. Okay, if you are putting a collateral, if you are securing that loan with a collateral or not. I'm showing you the quantity result only for private and public firms here, so you see the difference, and then the last 2 columns, the price spread result for private and public firms. The most interesting result here is actually not about monetary policy. It is about a normal time result. Okay, so the normal time result says that for private borrowers, collateralizing a loan is a must, right? That is associated with the improved access to credit. It's a positive coefficient. For public borrowers, it's exactly the opposite, okay? If you're collateralizing a loan, there's something wrong about that loan. There's something wrong about it, okay? And during the monetary policy expansion, this effect is going to be stronger. So you are going to get even more larger loans if you're a private firm because expansion of monetary policy is going down, so negative coefficient is going to add to this positive coefficient during those monetary policy. And for public firms, nothing is going to change. On the price side, the normal time result tells us that even without thinking about monetary policy changes, this collateralizing a loan is not only giving you more credit, it is giving you a lower spread. So this is a trade-off, right? If you're a financially constrained private firm, you don't have this luxury that financially not constrained public firm has, right? So if you want to get a lower price, lower spread, you are putting more collateral. For public firms, again, the result is exactly the opposite. You put more collateral, first of all, you don't get that much and you're paying a higher spread. So this is saying something bad about you. And by the way, there are other papers, a paper by Raghu Rajan, Ben Malak, and all that. They do say with different data set, same result for public firms. Collateralizing a loan is about something stressful about these firms, okay? Because they borrow basic unsecured. And during expansionary monetary policy, again, now these you put more collateral, you get a lower price effect, gets weaker for private firms, as it should be, because this DLB period monetary policy is also, narrowing down the spread. So it goes exactly as you would expect from your intuition, and of course, nothing going on with public firms. Now, the last thing I will show you before I conclude is this extensive margin result I showed you. So collateralizing a loan or not collateralizing a loan, that is driven by a certain type of collateral for private firms, and that is earning and operation-based collateral. So the same exact result here, same exact regression, I'm using collateral at the loan level and interacting the collateral type. Again, this is a dummy with the monetary policy surprises. For private firms, as you see, asset-based thing doesn't do anything for your credit amount. But if you put earnings and operation-based collateral, you get more and at a lower price during normal times. Okay, so normal time access to finance goes through earnings and operation-based collateral. During expansion of monetary policy, both work. So we have the standard Kiyotaki-Moore asset valuation channel through an asset-based collateral, and we have these other effect through earnings and operation-based constraint in terms of quantity of credit. For private firms, both work. But the price effect is going to come mostly through the earnings and operation-based collateral. For public firms, it really doesn't matter. What collateral type doesn't matter, because public firms don't use collateral anyway to start with. When they use it, okay, it is about because they have to use it because they are in distress. So any type of collateral basically is going to signal that you put collateral, you get less, you pay a higher spread regardless. Okay, and monetary expansion, monetary policy is not helping you, by the way, here because normal time effect is very strong. Okay. So, okay, I think, let me skip that. This is just to open up one more time, and then that earnings and operation-based collateral, the results coming from account receivable inventory and blanket bill, just to show that. I think I have like 3 minutes left, I believe. Anna, is that right?
Yep, 3 minutes.
Okay, let me just tell you very quickly what do we think the story by using this very nice figure from the recent Ottanello-Vimperi paper. So these guys basically write down a heterogeneous firming Keynesian model with default risk, trying to bring the Bernanke-Gertner story together with Kiyotaki-Moore story. So look at the financing cost and the net worth at the same time and the effect on investment, and their results are going to be theoretically ambiguous because with expansion of monetary policy, what is happening is you are going to have a higher price of capital, but at the same time, default risk goes down, so marginal cost curve can flatten, and the net worth valuation is going to be very important. You borrow less. This is exactly what Veronica was pointing out yesterday after Victoria's presentation. So this is basically from their figure, okay? So with a standard collateral constraint, in normal times, if you are a low leverage firm, risk-free firm, you operate at the intersection of the flat portion of marginal cost curve and marginal benefit curve. Monetary policy expansion shifts these curves up. You are a non-risky firm, so you still operate at the flat portion of the marginal cost curve because you have no default, okay? And if you're a risky firm, basically, you always operate before monetary policy expansion, black lines, you always operate at the upward sloping part of the marginal cost curve. Monetary policy shift marginal benefit up, marginal cost up because of higher price of capital, still you will operate there. Okay, and these guys say it depends on the data, which response will be there. So in our setup, we are fine with the risk-free firm operating at the flat portion of the marginal cost curve. What we are saying is if you're a leveraged firm and if you have an earning-based constraint, then a couple of things going on. Marginal cost curve shifts up with monetary policy expansion, the higher price of capital, pure cost effect. But then this network being more valuable flattens that marginal cost curve up. And if we have an earning-based constraint, that flattening is going to be even larger. And on top of that, you are going to flatten the slope because your credit spread now default risk is lower. So this entire response in investment can be much larger for a leverage firm just because monetary policy is going to make your collateral very valuable and lowering your spread. Why? Because your collateral is your earnings. Expansion of monetary policy is going to make it very valuable. And remember, this exact relationship here, this negative relationship, I show you that it holds in the data. Okay, let me conclude. The takeaways from our paper is we are documenting new facts about the US credit market that is highlighting the importance of heterogeneity both in firm size and type of collateral. And these things interact with each other, but they capture different things. And it's very important when you look at both the quantity and the price of a credit, right? Collateral and default risk is going to be positively correlated for listed firms, as the large literature argues, but it is negatively correlated for private firms because collateral is capturing access to finance for private small firms. This result is driven by SMEs, as we show in the paper. These private firms, SMEs, mostly use operational collateral, not fixed assets. What is operational collateral? That is something based on their earnings operations. So expansion of monetary policy is great for these guys because it's going to increase the able to pay and the value of that collateral. And the final point is that monetary policy effectiveness is going to depend on the presence of SMEs who use this collateral. And in terms of risk-taking and financial stability, I didn't show you those results, but this result doesn't mean there is no financial stability trade-off or no risk-taking here. In fact, leverage firms borrow more is telling you that there's a hidden financial stability risk. And this is something maybe we didn't look at before in a low rate environment because we didn't observe these firms, but that's something important to watch for moving forward. Thank you.
Great, thank you. Maria Cinta will offer a discussion for 15 minutes and then we'll open up for Q&A.
Cancel. Share screen. Thanks a lot for having me, and especially special thanks to Helen and Caterina for organizing this wonderful event. I cannot help thinking how nice it would have been in presence. So that's let me start doing step back. So what is our conventional wisdom of the effect of monetary policy? Well, up to 2008, 2009, when monetary policy was just conventional, our idea was that, well, when there are monetary expansion, this increases banks' ability to provide credit, and through the supply of credit, we see positive real effects. Now, since 2008, 2009, central banks around the world have started also to implement unconventional monetary policy interventions. What are the effects of these larger asset purchases? Well, the larger asset purchases affect bond markets. So we tend to think that larger companies that have a direct access to the bond market benefit more. So any benefits for small firms that around the world are the most frequent, the large, in aggregate, the largest employer, are going to be indirect. So, and this is a more recent literature, but this indirect benefit would arise, well, one, banks will have to lend less to bond issuing companies, so they can lend a bit more, they can supply more credit to small firms. And second, in recent work with Manuel and Miguel and Pedro Pires, we highlight that is to supply chains. Now here comes the paper of Shebnem, and it can be, in principle, in my reading, can make a very important contribution that changes the way in which we think of monetary policy transmission. Meaning that in my reading of the paper, the most important result was that Shebnem stresses the importance of the demand for credit from private firms. And this is something that is largely absent from previous literature. So let me get more in details on the finding of the paper and to give what are my comments. And again, Shebnem paper currently reads more as a research agenda that can lead to several influential papers, and therefore the results that I might be highlighting might not map one-to-one or with what Shebnem was discussing. So, and one of my advice is focusing and splitting. So as it was evident from Shebnem's presentation, she starts describing what are definitely great data for the US, okay? And there is a long discussion about the differences between listed and unlisted companies. This is stuff that is important to document also for the United States, but to a large extent, at least to European economists, this is unsurprising. Why? Well, in Europe, private firms have to file a balance sheet, so it is many years that we have been looking and contrasting the capital structure of private firms and public firms. So largely this finding tended to confirm that yes, private firms are different and they look in the US similar to Europe. So I view these as interesting descriptive evidence, but to some extent the way in which it is currently presented, I see it a bit distracting from what is the important contribution of the paper, that is far more than having great data. So what I think that the current great paper that uses this data should focus on is understanding how the monetary policy expansion affect the real economy, and whether we have really a mechanism that goes through the demand for credit from firms. So this is largely absent in the literature. I just want to highlight a recent Journal of Money, Credit and Banking by Carlo Altavilla and co-authors that using the surveys from the European Central Bank also highlights that besides the supply of credit that respond to monetary policy expansion, there is also the demand of for credit that is at work. So this could be complementary evidence. So, and Shebnem questions another conclusion that has been highlighted in a more recent paper of monetary policy transmission, that is banks, especially the ones that are relatively less healthy, do not appear to take relatively more risk. So let's there is a third set of results that in the paper that focuses on the type of collateral that different borrower post. So in this respect, these data are really fantastic. Most of other data sets, to my knowledge, do not have so much detail on the type of collateral that the company are posting. And in particular, it's nice to distinguish receivables, inventories, and future earnings as collateral from from real estate and cash and securities. I view the current interpretation of the results a bit more preliminary. I would like to understand a bit more where the selection problems are coming, but I think this is another future great paper to write. So let me get to the comments on the transmission mechanism. So what do we currently do? Well, in recent year, we all have been applying Kwajalein methodology, whether this is correct or not. That is, we look at how several banks offer credit to the same firm. In practice, from an empirical specification, we put a firm time fixed effect that will be the capturing the demand for credit, and we can interpret the estimate as how much banks with different characteristics supply credit to the same firm. Shebnem in the paper offers a very simple new idea, that is, well, let's do the reverse. Let's put a bank time fixed effect. Let's hold constant the bank ability to supply credit. And let's look at which companies are receiving more credit. In this way, Shebnem succeed in identifying demand effect. So the first reaction is, this is so simple and so smart. Then I started thinking of it a bit more, and there is an important assumption. And the reason why I was thinking of it as a bit more is that, especially in papers in which I've been using international data, so for instance, my work a few years ago with Luke, we have been including interaction of bank and time fixed effects, but we tend to have a very different explanation, okay? And part derives from the empirical setting. So what we want to do when we hold a constant a bank ability to extend that credit is to look at how banks in different conditions, in this paper is under different monetary policy regimes, are choosing to rebalance their portfolio. So in principle, it is possible that banks choose to rebalance their portfolio towards relatively riskier companies, even if there are bank and time fixed effects. So is this really a demand effect, or is driven by the fact that when the value of this collateral increases, banks optimally choose to rebalance their portfolio in favor of small private companies? So I would advise Shebnem and co-authors to think a bit more of this. The results would still be very interesting, because what we really miss in the literature is this focus on collateral and the focus on the value of collateral that changes with the monetary policy shocks, but perhaps is not simply demand, and the demand and supply are here a bit hard to disentangle. So that's but what I want to highlight in this a bit different interpretation of the finding that is based on the bank decision to rebalance its portfolio, possibly driven by the value of collateral, is that it is not clear that there isn't a bank higher willingness to accept risk when there is a monetary policy expansion. Okay, so what I'm thinking here is that banks may change the extensive margin of their portfolio. Now, this might be my personal opinion. I think there is nothing wrong with banks taking more risk when there is a monetary policy expansion. We want banks to expand the credit. What we would think is that the marginal loan they give is not as good as what they were giving in the past. And this is true for any capital budgeting decision of any firm. So let me go to my second comment, that is the sample period. So Shebnem already told us is mostly a monetary policy expansion. So what I would like to see a bit of discussion about is that these are monetary policy expansion and unconventional monetary policy that basically is a boost to bond market and increases for a large firm the supply of market funding, that is of bonds. So I would like to see some discussion of how much the fact that the expansion of credit goes through loan to small firms may actually depend also on the fact that there is unconventional monetary policy during all this period. So I have some other questions. So one thing that I am very curious about the data is how much firms in the US have multiple banks. We know that this is very frequent in Italy, but is not true for all firms in different countries. And this is very important here because one result that Shabnam highlights is that once we put firm interaction of firm and time fixed effect, all effects are insignificant. So there seem to be no differential effects between banks on the supply of credit. But this could be a lack of power because this identification based on multiple banks is particularly bad for the United States. We don't know. Another very interesting result is that the small firms, or finding, is that the small firms seem to have more floating rates loans. I am wondering how much these might affect the results on the use of credit. So because when there is a monetary policy expansion for firms with floating loans, of course, financial expenses decrease, so there is a further increase in the cost of capital. And also, I think that I would like to highlight is that small firms might demand floating rates loans because it's optimal for them. That's when they need more cash to invest because they have more investment opportunity. And this is actually another issue that can be studied with these great data.
Time is short.
Yes, just 2 minutes. Now let's come to the collateral results. Again, these are great data. There are a couple of results that are confusing and tell me that the specification is still subject to selection problems. Why? Well, we observe that the private companies pay a high cost for their loans when they pledge cash and marketable securities. Now, this ought to be better than receivables, inventories, and the value of the enterprise. So it ought to be that companies that are a bit worse are the company that are a bit worse can only get loan when they are pledging cash and marketable securities. And understanding this selection can help us more to explain what the specification is telling us. I have some other comments about quibbles about the data. So I think we observe the stock of bank loans, but then the static specification with the monetary policy surprise, isn't that too restrictive to think that there is a contemporaneous effect? Perhaps we need a more dynamic specification. And I would like to know whether these banks charge off more of their loans that are issued in this monetary policy expansion. There is something similar in the paper, but perhaps we can see more direct evidence. But overall, I think that this is a great line of research that goes well beyond the high quality of the data that Shabnam is using. And I look forward to read all the papers that will come out of it and to learn from them. So thanks a lot.
Thanks. I will turn things back over to Shabnam if you want to respond very quickly, because we only have 15 minutes, and then we'll call for hands.
Yeah, no, thank you so much. And I believe Matt answered the questions in the chat. And Marisunta, these are great comments. So we will definitely do just a couple of, I mean, we should definitely look at how banks, rebalancing their portfolio and all. We start looking at that, and then we don't find that they prefer certain collateral. So banks really don't care that much about risky or not risky collateral, but we should do more there. And I think this identification, lack of supply effect. I mean, there are supply effects. So firms do borrow from multiple banks. Otherwise, you would identify nothing, right? So it's just that they are not very strong, and they go the reverse. Actually, they are consistent with Luke's work with the Larachia. So looking at the bank data only. So they are just different than the European result. But of course, it can be the period. It can definitely be the CLB period. You know, banks don't, and it's short and everything is easy, so banks don't need to do this. So it can definitely be the pre. But we will definitely look at all these other dimensions. Great comments. Thank you so much, Marcy. Ken, thank you.
Maybe I'll take chair privilege while others might be raising their hand just to ask again or comment on the discussion point that was raised as a small detail about the data. But I actually wonder if you can talk a little more about how you think about new loan originations versus the stock of loans and the decision to draw down or not in terms of this kind of transmission channel. And I think particularly in this context of thinking about monetary policy surprises, because it takes quite a while to think about doing a new loan. And I guess I'm just wondering, well, I can see that in a kind of asset pricing context to look at a narrow window. I mean, does it really make sense to think about a monetary policy surprise and then you sort of suddenly decide, oh, I'm going to completely originate a new loan? So maybe just talk about, I think it has very different implications for the transmission channel, as well as perhaps for your measure of leverage. And so let me just expand on that a little bit. If you think about, I have a loan already, and it's an asset-backed line on my accounts receivable, and I just draw that down more. I draw that down more because I have a lot of sales for my business. Is that really higher leverage? It will appear like higher leverage because we have a sort of static balance sheet in assets. I assume that's roughly what you're doing. But in fact, you're selling more things and you have more revenue. So it's a little bit non-obvious to me that the firm is necessarily becoming more levered in that context. Whereas in contrast, if you expanded your sort of amount of committed, I think you could see that more potentially as a leverage increase.
Okay, let me just clarify this point because a lot of people ask that. First of all, we have stocks and new issuances. Okay, we can look at them separately. Right now, the regressions I showed you, like, using both, and we believe it is important to use both because, yes, you can issue a new loan, but you can also draw down on your credit line on a line that is backed by account receivables. We interviewed several firms and CEOs, CFOs, and the bank loan officers, right? This is how these are, a lot of them are going to be working capital loans. But they are short-term working capital loans. But that's how SME's life is. So this whole notion that you go and borrow 10 years for an investment project of 5 years, that is not the life of SMEs. And this is very important. We have to highlight that. So this is how it works. So like you pledge your account receivable, you draw down 2 million. Okay, then you have to submit a report to the bank, every few weeks on the value of that. So because you are booking that stuff that is going to come in 90 days, right? You borrow on that. Now, in 2-3 weeks, when you are going back to your negotiating, stuff is coming and you're doing great because the economy is booming, everything's great. You draw down another 1 million, right? This we definitely have. It is important to capture that effect because these are all going to be working capital loans, which are going to be very typical loans for these companies. Of course, you can also issue a new loan, a brand new one. In fact, this is very important. One of the identification there, remember, 666 effects. So this is not going to get into any selection of the firm and the bank, anything. This is between me and you, okay? My firm, your bank, there are multiple loans. We are securing these multiple loans with different collateral, okay? And the fact that I have so little fixed assets, I cannot get more than I need. But when economy is booming, I do need more. And I'm going to pledge the other stuff and I'm going to get more from you as a new loan and draw more further. So in that sense, it is definitely important to capture them. But we can definitely separate them and then, look at how much coming from the new and how much coming from the existing and the drawdown. One thing here, though, it is very, very, leverage is a right-hand side variable. Leverage is a stock variable on the right-hand side. That is meant to capture this differentiation across the firm, right? I mean, so leverage is not a time variable. And we know very well from the corporate finance work that, the early work by Rajan, Lemon, and Zenders, leverage doesn't vary over time, right? That much in the US. And this is actually even true for complete stat firms. So that's actually those papers are. So that is a right-hand side arrow. So it's a true difference in difference. You interact your very non-time varying stock of leverage with the monetary policy movement. And entire things identified through within variation over time with that, okay? And the left-hand side is either your new loans or you're more drawing from your existing. So both the stock and the new loans. And we look at the floating rates, maturity, and all that stuff. None of that stuff makes a difference, by the way. Okay, Helen, I think, has a question. Helen.
Yes, very interesting paper and discussion. So I'm learning a lot here. So I like Maria Assunta, so I think that the stuff on collateral is absolutely fascinating. And so I wonder if you can say a little bit more, and this is also came up in the chat with Vanya's question about the determinants of, why is there this asymmetry so pronounced between private and public? Is it about information transparency? Or maybe is there any other characteristics that you could look at? Is there any heterogeneity among private firms, that explains a little bit more the type of collateral that is used? That's one question, so that we understand a little bit better the selection here. And the second question is, you mentioned that these monetary policy shocks, so they have a different effects depending on the type of collateral that you use. But so how much cyclicality is there? So you said, if you use cash flow, you're sure you're going to have an effect. But what about real estate? There's also, so are these collateral, at market price, or are they at book value, or can you say a little bit more about the cyclicality of the different types of collateral?
Okay, so we should definitely do more on this. All comments are very well taken, but basically the collateral results I showed you, everything is with dummies, right? Like you collateralize or not, you use asset-based or not, earning-based or not. So the asset-based stuff supposedly market value, right? I mean, so there is a market valuation process done by the bank, and that's what we use. But of course, our argument is that it's a lack of that. So these small firms just don't have that much fixed assets to use. Okay, so that's where our argument coming from. Of course, is it capturing information asymmetry, default risk? I mean, it is hard to separate that. It should be capturing both, but it's just basically these guys. So this going back to tree and fruit, your fixed asset is a tree, and this is market value, right? But the fruit is your operations and earnings. Normally, you can't borrow against the fruit, right? I mean, future fruit, you can definitely not, but you are borrowing it based on the current fruit. And monetary policy expansion makes that current fruit more valuable. So think like that. I mean, this is a little bit like the new literature in terms of intangible capital, management know-how. All that stuff is fruit, and they go back to the soil and makes your tree more valuable. So yeah, right. But we should definitely do more. But basically, all we can say, that's the result that I skipped. But it is coming from blanket lien and account receivable, right? And blanket lien can have your property rights in it, by the way. But so in that sense, that cyclicality is of course going to be there, but it is also not a given that, so the asset is going to be less than cash flow is going to be more. But the result on the small firms, private firms, is definitely blanket lien and account receivable. They give you exact same result, not the others. And the asset stuff, yes, it does work as you expect, and it is at the market level. It's just that they have lack of it. They don't have enough of it, small, medium price and private firms. But we will definitely do more. All well taken comments. Yeah, so Matt is giving a better fertilizer example than I was giving. So we were very surprised with the results first too. So that's why we started interviewing all these companies, and it's amazing actually. So but we will do more. We will definitely pin down, because we agree that the collateral part is the most interesting part. Okay, I don't know if there's any more hands. I saw Helen.
I don't see any other. I don't see any other hands. Although there was that Matt may have just been so good at responding to comments in the chat. I don't know if we have 3 more minutes in case anyone kind of wants to offer up additional questions here.
Okay.
I had some data suggestions, but those are best left to an offline conversation,
all right,
because they're unlikely to be.
Thank you so much. We noted down hopefully everything. And Marisunta, great comments. Thank you so much, Marisunta. Please send your slides to us, and we'll
of course.
we'll work on it. A lot to do. Thank you so much. Great suggestions and comments, everyone.
Great, thanks. And thanks to allowing us to keep on time. We're going to move on to the final paper in this session, where Martina will discuss monetary policy, labor income redistribution in the credit channel, looking at evidence from matched employer, employee, and credit registers. Martina?
All right, perfect. Thank you so much. Can you see my slides and can you hear me well? Excellent, perfect. So as probably every speaker of the day, I'd like to really honestly and sincerely start by thanking the organizers for putting together a fantastic conference. I've been greatly enjoying the past 2 days. And so today I'm going to talk about monetary policy and labor income redistribution, which is a joint work with Caterina, Ettore, Jose Luis, and Dominic. Caterina and Dominic are here on the call, and most importantly, Dominic is on the job market this year, so look out for him. All right, so I'm going to start by motivating this paper with 2 pieces of evidence. The first one is something we've been talking about both yesterday in the panel, and also it came up this morning. And it's this thing that monetary policy has been paying a great deal of attention to inequality, both income and wealth. Now, this is true in the couple of speeches I'm listing here in the first bullet point, but also more broadly, the Bank for International Settlements has put out their annual report this year. When they track the speeches of the central bankers, both in advanced and emerging economies, they're mentioning the words like redistribution, inequality, and so on. And they've seen that across the board, really the attention has been rising in all the central banks worldwide. Now, this is not to say that monetary policy is meant to redistribute income or wealth in the economy, but as we can see, the policymakers are paying more attention into the potential redistributive consequences that their monetary policies might have. Now, if you look more deeply, both the policy and academic research has been primarily paying attention to the effect of monetary policy on capital income, and as a result, the consequences for the wealth inequality. Much less is known about the role of the labor income inequality, and that's where we want to contribute. At the same time, we have also seen a rising literature in the heterogeneous agent models in the modern macro. And here I'm again just listing a few papers in this growing field that has really been looking into who are the winners and losers of monetary policy when it comes to income, consumption, etc. Now, this field, again, is really growing, but one thing that is still a little bit missing is understanding more the details of the earnings channel. In other words, how exactly the labor market plays out into this redistributive effect that we then observe and study for households. So in this paper, we are after asking and answering 2 questions. And those are, 1, how does the monetary policy affect labor income inequality? And 2nd, what is the role of credit in the transmission mechanism? Now, this is an empirical paper that I'm going to present. And if you look around, the empirical evidence has been largely limited. And the reason for that is twofold: data challenges and identification issues. On the data challenges, most of the things, especially from the earlier parts of this literature, is based on survey level data. While this is incredibly important, there are certain measurement issues and problems with granularity. Most importantly, you cannot track workers over time as they move between the firms to really identify the effects of workers, firms on their wages, and really isolate the effect of monetary policy. Now, most recently, we have seen a rise of administrative type data sets that can maybe help answer this question, but the problem still remains in answering my 2nd question, and that is the role of the credit channel. So ideally, you might really want to have a link between the data sets that not only have a detailed insights into the labor market of an economy, but also into the borrowing of, say, firms in the very same economy. The 2nd problem with, or the challenge that the literature has been facing is based on identification. So we want to study how monetary policy affects the labor market, but there is a huge endogeneity problem, meaning monetary policy reacts to the labor market. That needs to be addressed when you want to go into this agenda. So in our paper, we bring in the settings of Portugal, and we argue that our focus on Portugal actually is extremely suitable as it allows us to address these identification and data challenges.
And let me give you an idea of what I mean. On the data side, as the title of our paper suggests, we are able to bring in a matched data set of the employee-employer administrative data for all private sector firms with at least one paid employee. And we are matching it with the credit registry that provides a universal coverage of bank loans to firms with exceeding 50 euro. So you really are capturing a lot of the credit channel as well as the labor market. Now, on the identification side, we're going to leverage on the fact that Portugal is a tiny country at the periphery of Europe, and it contributes approximately 1.8% of GDP to the Eurozone economy. And as the research has been showing, it has been largely disconnected from the rest of the Eurozone, especially in the first decade of the Eurozone creation. And so we are going to investigate the impact of the monetary policy set by the ECB in Frankfurt since the 1999 on the labor income redistribution in Portugal. And I'm going to show you in more detail later that it's actually quite a valid setting, and you can treat the monetary policy changes as exogenous to the local labor market conditions in Portugal that we want to study. Now, in the paper, we are going to do lots of things. And even though I have half an hour, I don't think I will do justice to all of our results. So before I go into the details, I want to give you the preview of the main findings. So the paper essentially has two parts. In the first part, we document the heterogeneous effects. In the second part, we talk about the credit channel. So let's start with the heterogeneous effects. So we look into a range of heterogeneities. The first one is the heterogeneity at the firm level, and we show it on a couple of labor market outcomes. The first thing we show is that softer monetary policy, so think when the ECB cuts rates, it's going to increase wages more for workers in small and young firms compared to workers in large and old firms, especially if these firms are highly levered. Now, I'm going to show you that this is consistent with the backloaded wage mechanism. And according to this mechanism, monetary policy relaxes the financing constraint for firms and allows these firms to increase wages of their existing workers whose wages were previously backloaded. Now, in addition to the wage outcome, we also turn the attention to employment and hours worked. And similarly, we find that softening of the monetary policy increases employment and hours worked more for workers in small and young firms. Now, firms can hide lots of things. So as a second step, we move into the worker level heterogeneity. And specifically, we focus on the skill of workers. So whether the workers have or do not have a college degree. And we find that high skilled workers benefit the most from monetary policy softening. We find that this is consistent with the capital skill complementarity mechanism, which goes as follows. We show that softer monetary policy allows financially constrained firms to, at the same time, increase capital investment and employment of their skilled workers. Now, with all of these documented heterogeneities, we ask to what extent credit can shed a little bit of light into the transmission. And we go into the credit data and develop firm level exposure to the credit channel to monetary policy. And specifically, we do it in two steps. We think about borrowing from the literature. A credit channel could be prevalent through the firm borrowing channel or through the bank lending channel. And we find that both of these channels are at play. In other words, we show that monetary policy easing alleviates firm and bank financing constraint, and it specifically eases the access of credit to firms with stronger sensitivity of borrowing to monetary policy, which is the firm borrowing channel, or the firms who are borrowing from less healthy or less liquid banks, which is a bank lending channel. And as a result, these firms that are more sensitive, either through the firm or the bank channels, are now increasing the wages and employment of their workers by more. One additional contribution we make here with the firm borrowing channel that I'm going to talk about is that we develop a novel proxy of the firm borrowing channel without paying special attention whether these firms have to be small or have to be young. We directly observe their borrowing behavior in the credit data. Now, the final thing we use this paper for, and this is really where the setting of Portugal comes extremely handy, is that Portugal is one of those economies that, unlike, say, a bunch of the Scandinavian countries, have really suffered through both booms and busts. So we are able to ask how state-dependent our results are. And we are able to compare our results in good times and in crisis times. And what we find that these effects that I've just explained are 2 to 4 times stronger in crisis times when financing constraints are the most severe. All right, so a few words about our data. So we built a micro level data set that really allows us to study this entire transmission. At the core of the data set is the administrative employee-employer data that allows us to observe the universe of private sector firms in Portugal with at least one paid employee. And we're using this data since the Eurozone creation, so 1999, up to 2013. Now, the data comes with very rich observables, both on the workers and firm side. The most important for us is that we are going to be able to observe the regular monthly salaries, additional bonuses, plus, importantly, hours worked. Now, the real contribution of the paper comes that we are able to match the employee-employer with the credit registry. Now, many of you are probably familiar with the credit registries either in Portugal or Spain. So they come at in universal coverage, meaning the reporting threshold is €50, and they provide very detailed loan level information at the month level. And we're going to match these two together to actually study our question. Now, in addition to this, we complement our data with additional firm and balance sheet, firm and bank level data, such as the balance sheet data. For firm level, we bring in profit and loss statements, trade data, and for banks, we bring in some additional supervisory data. Now, few things about the monetary policy. So in the paper, I won't have probably too much time to show you this here, but in the paper, we show quite extensively that if you think about Portuguese labor market, the monetary policy changes done by the ECB, especially up to 2013, are really largely disconnected to the domestic business cycle. And as a result, in the main specifications, we use the key policy rate, or in other words, we use the EONIA. EONIA is essentially the European version of the Fed funds rate. And I'm gonna present the results with this. Now, we redo all our results in the robustness using two additional measures of monetary policy. First, we use shadow rates. If you especially worry that towards the end of our sample, the monetary easing could be triggered by things like fixed rate full allotment or LTROs, the shadow rates are gonna capture monetary easing that goes well beyond just the cut of the interest rate. And our results will be robust. The second thing is related to other papers in the literature that are using the monetary policy surprises. Now, in the paper, we explain quite in detail that it's actually not so necessary for us to use the monetary surprises because the shocks are kind of, the monetary policy itself is quite orthogonal, but we redo everything with the monetary policy surprises from the Karadia-Roczynski series, and we find that, again, the results hold. Now, finally, we will always in the regressions control for some macro variation, either on the GDP growth, inflation, or on the financial cycle we fix, because what we are really interested in is that how much does monetary policy itself contribute to this rising dispersion in wages above and beyond of some additional dispersion that can be driven by the business cycle dynamics. So let me be more specific. I'll start with documenting the labor market effects. And specifically, I want to show you the main equation that we are going to estimate. So the question we are asking here is, how does monetary policy affect wages based on key worker or firm heterogeneities? In this regression, I'm showing you the firm heterogeneities. So on the left-hand side, I'm going to have the log of an hourly wage of a worker W in firm F in year T. And specifically, I'll be interested in the orange term. So the R here is going to denote the leg version of monetary policy. So for my talk today, it's going to be the EONIA, but the robustness is done with shadow rates or monetary policy surprises. And importantly, we're always going to introduce one heterogeneity at a time. So for example, H can be a variable that takes a value of 1 if a firm is small and 0 if a firm is large. We're going to repeat the same with H, and then I'm going to move to worker heterogeneities. Now, a few things to notice here. The first thing is that we are going to control for additional heterogeneity that's denoted here with the X that comes from the business cycle dynamics or potentially VIX. The second thing that we are going to control for is very common in the labor literature, which are the fixed effects, the time fixed effect, worker fixed effect, and firm fixed effect. This is done in the same spirit as all the AKM models in the labor market literature, meaning we are going to track the workers over time as they move across the labor market to separately identify the time effect on their wages, their worker effects on their wages, and the firm effect on the wages, which we know that have important contribution. And this is going to allow us to isolate the additional contribution of monetary policy on their wage dynamics. So this is the final bullet point here. So we're going to saturate with the fixed effects. All right, so let me start by showing you some results. So I'll start with the firm size. So I'm going to create a dummy variable small firm, which is going to take a value of 1 if a firm has less than 50 employees and 0 if it's a firm larger than 50 employees. So in the first column, I'm showing you more of a smell test. And let me say something about it. So what you can see here first is that the coefficient on the monetary policy is negative and statistically significant. So this is just a smell test in the sense that when the rates go down, we observe the wages going up. And in the same spirit, we see that the wage dynamics is stronger for workers in small firms. Now, let me move directly to the column number 4, which is really in line with the equation I just presented. And what you can see here is that we can interpret as a 1 percentage point decrease in the monetary policy rate is associated with approximately 1.16 percentage point increase in wages of workers in small firms compared to wages of workers in large firms. Now, graphs are probably better than figures, so let me show you this graphically. And here I'm taking firms and sorting them into quintiles based on their size, and I'm using the largest quintiles as my reference category. And what you can see here is that following a monetary policy softening, workers in small firms benefited disproportionately more than the workers in the largest firms. And this effect is markedly linear in the firm size. Now I'm going to do the same thing, but now looking at the age of the firm, which is shown in the figure right here. So again, the oldest firms in the oldest quintile are my reference category. And what you can see is, again, workers hired or working in the young firms benefit disproportionately more in terms of their wages following a monetary policy softening than the workers in the oldest firms. Now, the big question you might want to ask is, why do we see this happening? And what does this mean for inequality between firms? So let me start with the latter. So one thing that is true for probably any setting is that small and young firms generally tend to pay less. Now, let me be specific. If you go to Portugal, we can compute a conditional wage gap. What I mean by conditional, we're comparing 2 workers in the same region, industry, at the same occupation coding. So imagine 2 accountants, one being employed in a large and one in a small firm. And we see that such conditional wage gap between the firms based on size is 25%. And for firms across firm age is around 10%. So we see that small and young firms really do pay less, even conditioning on these characteristics. The second thing that's important in the literature is that we know that small and young firms tend to be financially constrained. And especially the labor finance literature has shown that financially constrained firms tend to pay backloaded wages. What does this mean? It means that because the firm is financially constrained, it tends to borrow from its workers. So it pays below equilibrium market wages with a promise that when this financing constraint for the firms gets resolved, the firm is going to increase the wage profile and start paying steeper wages than otherwise. Now, we put these 2 things together, and what we show in the paper, is that softer monetary policy relaxes the financing constraint, and especially we see that small and young firms are able to increase wages by more. This means that we observe that the labor income dispersion between firms decreases. And I'm going to show you this in 2 steps. In the next slide, I'm going to show you that small and young firms in Portugal indeed pay backloaded wages. And I'll do that by comparing the wage response of new hires and existing workers to monetary policy. Later in my talk, I'm going to move to the credit registry data, and I'm going to show you that small and young firms actually have stronger sensitivity of their credit to monetary policy by developing an agnostic measure of credit sensitive to monetary policy directly from their borrowing behavior in the credit registry. So, backloaded wages, let me show you what I mean. So we're going to compare the reaction of wages based on whether the worker is in a small or large firm, and furthermore, whether the worker is a stayer or a new hire. So the first 2 columns are showing you just within the universe of small firms, we see that wages of stayers are rising by more than the wages of new hires. In the second 2 columns, 3 and 4, you see that there's no such effect for workers in large firms. And then finally, if I move to the final columns 5 and 6, and I'm pulling the sample together, you see that In response to monetary policy softening, all workers in small firms benefit disproportionately more in terms of wages than workers in large firms. But even more so, we see the strongest effect for stayers in small firms, which is really in line with the backloaded wage contract mechanism that says that these workers were being paid backloaded wages, and following a monetary policy softening, the firms are really delivering on their profit promise, and they're paying steeper wage profiles to their workers who were stayers and were previously backloaded. Now, a few words about the other margins. So similarly, we look into hours worked and employment. And as you can see in this graph, in this table, you see that both effects are negative and statistically significant, speaking to the fact that, again, following a monetary policy softening, workers in small and young firms also increase the number of their workers, and as well as the hours worked. Now, one result that I want to talk about a little bit more is when we turn to the worker heterogeneity. And specifically, we are interested in seeing whether there's a difference in the skilled and less skilled workers. In columns 1 and 3, I'm showing you the heterogeneity based on whether the worker has a college. So the college W takes a value of 1 if the worker is college educated, and 0 otherwise. And what you can see is that following a monetary policy softening, both wages and hours worked increase for college educated workers by more than the workers that don't have a college. Now, the Portuguese data come at crazy amount of detail. And one thing that you can see is what type of college these workers actually have. So we are able to disentangle the college degree into whether this is a STEM degree or some other college degree. And what you can see in the columns 2 and 4 is, first of all college-educated workers tend to benefit more, but this effect is really accumulated across in the group of college workers that have a STEM degree. Now, why am I mentioning this? I'm mentioning this because we're linking the result on the college premium, on the rise of the college premium, with the capital skill complementarity. So here I'm showing you that the high skilled, especially technically high skilled workers, are benefiting more from monetary policy softening. Now, a different way how I can show you this is that you can ask me, how does this match with the firm heterogeneity that I just presented? So here we're creating 4 categories, and I'm using the reference category as a college-educated workers in large firms. And what you can see is that following a monetary policy softening, all workers in small firms benefit relative to this reference category, but the strongest effects are observed for college-educated workers in small firms. So we see small firms are hiring and paying more to their college skilled workers. Another thing that we're seeing to really develop the capital skill complementarity is that these small and young firms are also increasing their capital investment following a monetary policy softening. So taking these 2 pieces together, we argue that, that one of the channels that is really active here is related to the capital skill complementarity. Great. So let me use my final 10 minutes to tell you a little bit more about the credit channel. Now, there are many ways how you can talk about the credit channel, but before I do that, let me just do something very simple. And that is, I showed you until now that small and young firms benefit more, or workers in small and young firms benefit more. Let me split the small and young firms into 2 categories: small firms that borrow from banks and small firms that don't. And that's what I'm doing in columns 1, and column 3, I'm doing the same for young firms. In columns 2 and 4, I'm proxying for it differently, and I'm saying small firms that have leverage and those that don't, or at least, like, I mean, the continuous variable here. Now, what you can really see here is that the result that I told you about, that workers in small firms benefit more following a monetary policy softening, is really only visible in workers of small firms that have existing bank borrowing relationship. We don't find any redistributive effects inside firms that are small without bank credit. So this really just suggestively starts speaking to the fact that the credit is going to be important. Now, to be more formal, we're going to think about the credit channel in 2 ways. Specifically, guided by the literature, we're going to think about the firm balance sheet channel, a la Bernanke-Gertler, that says that softer monetary policy increases firms' asset value and net worth, and as a result, extends firm capacity to raise external funds. The second argument we're going to make is related to the bank lending channel literature. So think like Bernanke-Blinder, Kashev-Stein, that says that monetary policy positively affects provision of bank credit supply, especially in specific banks in the economy. And this magnitude depends on the strength of the bank balance sheet or a bank's liquidity position. So let me be more precise. I'll start with the firm balance sheet channel. So we're going to test the hypothesis that the monetary policy propagates more strongly to wages of workers employed in firms that have higher sensitivity to their credit to monetary policy, measured through the firm balance sheet channel. And I'm going to do this by developing a novel approach to compute this sensitivity directly from the credit data. And the benefit of this approach is that it's very agnostic, and it doesn't require us to make a stance on the fact that every small firm must have a stronger sensitivity or every young firm must have a stronger sensitivity. Let me show you what I mean. So we're going to go into the credit registry data, and we're going to estimate the following regression. On the left-hand side, I have a log credit data of a firm F borrowing from bank B at month T, and I'm interested in capturing these firm level betas. So the firm level beta is going to capture the firm level balance sheet response to monetary policy in an agnostic way. So I'm going to retrieve for each firm its own beta. Now, as we discussed with the Sednam's paper, we're going to introduce a couple of fixed effects. Specifically, we're going to put in the bank time fixed effect to essentially address this literature on the bank lending channel that banks of different health or different liquidity might propagate monetary policy differently. And the second thing, we want to be sure that we address a potential demand for final goods that could of a firm that could potentially confound our results as well. What I mean by that is we're going to control for sector, region, time fixed effect in our regressions. Now, the betas here should say that the more negative value of the beta is, the stronger sensitivity of firm credit to monetary policy we're seeing. So before using this beta further, let me tell you how they actually look. So the literature previously has argued that small and young firms tend to be more financially constrained. So let me take my estimates of this firm balance sheet channel and show you how they correlate with the size and age. And what you can see, it is really true that small and young firms have more negative betas. In other words, our proxy here is not completely crazy compared to what we've seen in the literature, but it probably does a little bit better job because we are not able to, we don't need to say that all small or young firms are more sensitive, but overall we see that small and young firms tend to be more sensitive to monetary policy. Now, I'm going to take this sensitivity of the firms, and I'm going to use it as a heterogeneity in my inequality regressions. So I'm going to use some of the outcomes here. So either the log of wages, hours worked, or employment. And this is the same regression as you saw in the beginning. But the difference here is that now my firm level heterogeneity is the firm level dependence on the firm balance sheet channel through the credit registry data. In other words, if the firm balance sheet channel is at work, we would see that the labor market outcomes of workers employed in firms with stronger sensitivity of credit to monetary policy will increase by more when the monetary policy softens. In other words, we would see the theta coefficients to be positive and statistically significant. Now, turning to the bank lending literature. So bank lending literature has been very large, and it has essentially argued that the monetary policy propagates differently based on the position of a bank. Now, what do I mean by that? We're going to use two proxies. One guided by the literature of on the worst bank balance sheet health. We're going to say that we're going to test whether less healthy banks propagate the monetary policy more strongly, and as a result, firms that are connected to less healthy banks see that they adjust the wage outcomes of their workers differently. Now, to proxy for bank health, we're going to borrow off the shelf from Amity Weinstein's JP paper. So we're going to run our credit registry data to estimate these bank shocks. So the bank time fixed effects, and we're going to use them. The second way how you can think about bank lending channel is a little bit simpler, and that is a la Kashyap-Stein, which says that less liquid banks propagate monetary policy more strongly. So we're going to come to our bank balance sheet data, and we're going to construct the measure of the liquidity position by using the balance sheet information. Now, I'm going to use these two measures. I'm going to aggregate it on the firm as a weighted average of the firm credit from these banks based on their health or liquidity. And again, I'm going to use it as a heterogeneity in my wage regressions. So let me show you the results. The first column is showing you the results for the firm balance sheet channel. The column 2 and 3 are showing you the results for the bank lending channel, where I either control for measure bank lending through health or through their liquid assets. Now, what you can see in all three columns is that conditions are positive statistically significant, which speaks to the fact that when rates fall, wages of workers in firms with stronger sensitivity of their credit to monetary policy, meaning firm balance sheet channel, or firms borrowing from more financially constrained banks, meaning less healthy or less liquid, increase the wages of their workers by more. Now, I won't have time to go into the details, but in the paper, we do the same thing for employment and hours worked. And we again find that the credit channel plays a very important role in explaining those results as well. So I'm going to conclude by saying that in this paper, we document that monetary policy has important implications for redistributive effects on the labor market. And specifically, we show that firms that are high risk premium and workers that are high skill premium benefit the most when monetary policy softens. And finally, we bring in the credit level data to document that the credit channel plays a very important role in the transmission of monetary policy, also to the labor market outcomes. Thank you.
Great, thanks very much. I will turn the floor over to Claudia, who will offer a discussion for 15 minutes.
Sure, can you hear me well?
Yes, I can hear you. I
Excellent.
cannot yet see your slides.
Oh, I have them. Okay, so let me see. So do I have to share or? Oh, I can. I see. Wait.
Yes, you share.
Share screen. Okay. Excellent. Do you see my slides now?
I can currently. Perfect. If you want to go to full screen, I can see your slides though. Great, all set.
Excellent. Thank you very much for the committee organizers. I'm probably, one more that thanks this initiative, which is fantastic. And actually, I was super happy about reading this paper. Martina, you presented it really nicely, and reading the paper is also was really interesting, a really interesting reading. It has a lot of material. The data is great. So let me just jump into my discussion. So as an initial slide, a broad summary of my reading of the paper. So the objective of the paper is to identify how, via the credit channel, monetary policy impacts labor market outcomes of firms and workers. And as Martina explained, the context they use is Portugal, and it provides, looking at Portugal, provides two fantastic advantages to study the impact of monetary policy. First, Martina explained them. Monetary policy is clearly set by the ECB, and within the Eurozone, we know that Portugal represents less than 2% of the Eurozone GDP. So there's, reasons to believe that this monetary policy is not fully taken into consideration the context of Portugal. Some might argue that still there's some endogeneity, but clearly much more cleaner than if you look at other countries where the domestic regulators are clearly paying attention to what is happening in the economic, local economic context. So the second advantage of looking at or studying Portugal is the data. So as Martina explained, they use fantastic data, very rich data set. Not only they have access to firm level data, but they have access to the pairing of firms with workers, and then they manage to match this data to credit registry data, to bank level data. And not only that, but they also look at the time series from 1999 to 2013. So the data is as good as it gets, I think. And using this data, the paper is an empirical paper, and there are some novel findings on effect of monetary policy on labor outcomes. The paper finds that softer monetary policy is increasing wages and unemployment. But I think the core of this paper is the heterogeneity, as Martina was saying, of this effect. So clearly, they find a lot of heterogeneity across firms. So they see that effects are stronger for small and young firms who are firms that tend to be more credit constrained. They see a lot of heterogeneity across workers. They see effects are stronger for incumbent workers or the stayers rather than the new hires. They see effects are stronger for high-skilled workers, workers with a college degree, and for workers, especially in the STEM, with college degrees in STEM. And something that I think Martina didn't mention in the presentation is that they also find a lot of heterogeneity over time or across the business cycle. So clearly, the effects are much stronger in crisis years, which is something also super interesting. All in all, I think the paper provides very solid evidence documenting the credit channel as a mechanism tying these or tying these two results, or this tying monetary policy to labor outcomes. And how, so this is always very difficult to tackle, but given the data that they have, they manage to link credit registry data to firm level and bank level data, and very convincingly they provide this evidence. So let me start actually with this last point, so the credit channel in the paper. So again, I repeat, the paper I think does a great job documenting evidence of this channel. I think this was my favorite part of the paper when reading it. So first, the paper uses firm level data on labor outcomes, and first just shows how young and small firms, which tend to be more credit constrained, are more sensitive to these shocks in terms of their labor outcomes. But then they go a bit further because they have this loan level data, and they link this loan level data with firm level data and show how when they look at these young and old firms, only those that in years when monetary policy softened had access to credit or had credit are those that are changing their labor outcomes. So if you're a small and young firm but did not have access to credit when there was this easing of monetary policy, we don't see your labor outcomes changing. For me, this was a very telling evidence of the credit channel. But then they go even further. They look at firm balance sheet information, and they develop this firm level credit sensitivity to monetary policy that Martina was talking about. And they show that higher credit sensitivity, firms with higher credit sensitivity, are those that are responding more in their labor outcomes. So all in all, everything seems very consistent with the credit channel. At the end, as Martina said, they also verify that it's not only the credit channel coming from the firm balance sheet, but also from the bank's bank part. So they see that among all firms, especially firms that are borrowing from banks that are financially more constrained, so these are less healthy banks, less liquid banks, are more sensitive to movements in monetary policy. And then, so this was how the paper linked, or the mechanism behind these results, that is the credit channel. But then on the heterogeneity of labor outcomes, I have some comments. Let me summarize how I read the results, and then make some comments on what parts were not very clear to me. So on the heterogeneity across firms and workers, the paper first documents that the effect of monetary policy is greater among young and small firms, but within these firms, the effect is greater for incumbent workers. And what this means is that relative to new hires, wages and hours worked of incumbent workers increase as monetary policy rate drops. So one comment here, and I think in the chat it appeared, David, is how should we think about changes in wages of incumbent workers in a context of wage rigidities? Now, how would wage rigidities affect these results? Are wage rigidities different for incumbent workers than new hires? So how much of this is contaminated by this? Another question or another point is that, so first they show that among young and small firms, it is stayer workers that benefit more from monetary policy. However, a second piece of evidence, when they go and look at heterogeneity of workers, what they find is that relative to workers with no college, it is workers, high-skilled workers, workers with a college degree that are paid more and work more hours when monetary policy softens, no? So this is interesting because as I read it, I first understood that stayer or incumbent workers are benefiting, but then it seems that when
we're occasionally losing your sound.
Oh, I'm so sorry to hear that.
I wonder if you want to go off video and maybe just talk, and we'll see if that goes a little better.
Okay, so let me stop my video. Let's see if this improves things, okay?
Thank you.
Okay, so then, so what I was saying is that across workers, we see that workers with college degree are doing better when monetary policy softens. However, one question here in the paper, it is suggested that high-skilled workers, or these workers with college, are reallocating from large oil firms to small young firms, no? But this, I found it somewhat confusing, as the first evidence that the paper provided was that the workers that benefit are the incumbent workers, not the new hires. But then it seems that it is college degree workers that are coming from large firms that are benefiting in their wages. So how can you connect these two findings, no? And then on a third point, following, so first you show the stayers benefit more, the workers with college benefit more, and then you say, well, not only college workers benefit more, but college workers that are in STEM. So here one question that I had is, could you elaborate more on this? Why are STEM workers demanded more by small and young firms? Is this effect driven by some sectors? So we know in Portugal, high-tech startups have been increasing very much in the country. So how much of this is driven by small firms being in the tech industry and demanding more STEM workers? So those comments are on the heterogeneity of labor outcomes for firms and workers. And then I have other comments on the heterogeneity of labor outcomes over time. So in the paper, you show that the effect of monetary policy is stronger during crisis years. However, in the paper, the results are only shown for changes in GDP growth, right? Not for whether there is a crisis or not. So it would be very nice to actually see the results on, okay, so what happens when, you know, like GDP is negative, the growth in GDP is negative. So to really see what is going on crisis years. But here I also have a comment, because what here you show is that, okay, effect of monetary policy softening is stronger in crisis years, but then I don't know if this is consistent with your hypothesis or explanation of the backloaded wages, because this hypothesis tells you that firms, small firms that are credit constrained, basically try to compensate workers, right? When they when their financial situation improves, and they compensate workers by offering them higher wages. But if these effects are concentrated in crisis times, it is a bit strange for me to think that when unemployment is higher, when domestic demand is lower, firms are deciding to, this is the right moment to compensate my workers with high wages, right? So how can you connect these backloaded wages hypothesis with your results that it is in crisis times where monetary policy softening is really changing labor outcomes? My sound is better, by the way, or am I just talking and no one is understanding?
No, the sound is better. Thank you.
Okay, excellent. So similar on this heterogeneity of labor outcomes over the business cycle, one thing here is that the effect of monetary policy may be stronger in crisis years because of its role also on aggregate consumption, right? So not only firms' borrowing costs go down, also consumers. So in the paper, there's no much discussion on this. So what is going on with, or how are you guys seeing the effect that monetary policy has on demand? And here, I understand that, well, here clearly, I'm not sure if demand of certain sectors, you know, goods from certain sectors is increasing more, and are small young firms in these sectors, or how are you seeing this other dimension of monetary policy? And then another question on this same topic of the business cycle, the effect of monetary policy over the business cycle, you only show it for wages and hours worked. So to connect with the rest of your story, it would be really interesting to see how the other outcomes look over the business cycle. So are results still consistent? For instance, how do you see still that incumbent workers benefit more in crisis years, college workers benefit more in crisis years, STEM workers benefit more in crisis years? This, I didn't find this in the table, in the paper, I'm sorry. So moving on, I think I still have some minutes left. So I think this is crucial, no? And there's almost nothing in the paper on it. What about the Portuguese context, right? So we know that legislation to protect employment and wage rigidities in Portugal is really tough. And don't get me wrong, my husband is from Portugal, full disclosure. So not attacking the country in any way, but of course, the labor market is among the most rigid in Europe. So nominal wages cuts, for instance, in Portugal are banned. So within this context, how should we, so I understand that there are like very big advantages of looking at Portugal, but how to take this wage rigidity in consideration? And there's not a mention in the paper on wage rigidities, no? And not only that, but also within the country, one question that I have is there variation in wage rigidities in labor protection regulations, for instance, across workers, across firms, across sectors? Are wage rigidities laxer among small young firms? If these small young firms are in the tech sector, perhaps they have more flexible contracts, and how this will harm or not the findings that you have. For what type of workers is dismissal more costly, or wages, you see wages increasing more? So you have the college degrees, the non-college, the STEM. So how these different heterogeneities that you explore relate to differences in rigidities, right? In rigidities in labor protections, and to what extent these rigidities may be influencing your results. And in this same point on the context, what type of, so for me it was not very evident what type of wages you use in the analysis. Are you using real wages, nominal wages? So I think in the chat there was some mention on this. So clearly wages are not going down, they don't go down. So you only see wages or stagnating or going up. So what about other compensations that firms can use? So you see, you see bonus, you see in the data bonuses. You can see, I don't know if you see benefits, promotions. So these are other strategies that firms may use to, to not increase wages. So how much these strategies are used differently by different types of firms? Well, related to this question, the paper mostly interprets all these results of a softening of monetary policy. So what about, given these wage rigidities, how about the contrary? So how should we interpret these results when there are monetary policy contractions, especially given that wages are not going down? And let me move on. Okay. So I think I just will talk for 2 more minutes. So how different in the paper or in Portugal or in your sample are small and young firms from large and older firms? So I think the paper here should really dig more into, give more detail on what exactly are we comparing here. So again, to what extent results may be influenced by sectors, the sectors of young and small firms. So clearly here, I think it would be useful to explore relative to old and large firms, how is the sectoral distribution of young and small firms, document these differences. Again, as I said it before, are these firms more likely in tech sectors or startups? And I say this because it strikes me a bit that the STEM workers are being hired by these firms when they, when credit constraints are reduced. Or is it that these firms are more likely in tradable sectors that are less affected by local economic downturns? And then it also coincides with you finding that the business cycle monetary policy is more effective in downturns. Is it a trade, is it a story of trade of sectors? In terms of data, I would also like to know how is the coverage and quality of the data that you have, especially for small and young firms. You have a lot of years starting in 1999. In my experience working in Mexico with these long time series data, the coverage at the beginning, in the beginning years is not fantastic, and over time it starts getting much more better. So do you see the same? Because one concern here is that, well, not concern, but something that might happen is that recent years are dominating the effects. And if that is the case, do you see in your data the growth in startups in the tech sector that has been happening in Portugal? Because then I think this may be linked to, again, your college degree with your STEM results. And if that's the case, this discussion of bringing in these changes may be relevant. And also other considerations that we don't know from reading the paper, how different are small young firms in, for instance, their survival, the type of workers they hire, what fraction of the workers are new hires, college degrees. All this information I think would provide very useful. And just to conclude my last 30 seconds, So summarizing areas that the paper can strengthen, one is to bring more clarity on their storyline. So you have a lot of results in the heterogeneity, but I'm not I was a bit confused on somehow or sometimes how these results connect with each other. I think the paper would benefit from a deeper discussion of the local context and potential threats that this context may have. And more descriptive statistics would be very useful, more information on outcomes across firms and workers, in what dimensions are young firms and small firms different from their other peers. But overall, my assessment of the paper was very positive. The paper is very solid. The data is out of this world. I want to work with that data. The empirical work was done very carefully. The results are very interesting, and overall, I think it's a great contribution to the literature. So I'll stop here. Thank you so much.
Thanks so much. Martina, I'll hand it back over to you to respond to that detailed discussion and then open the floor for questions.
Perfect. Claudia, thank you so much for your great discussion. I see Dominic has done a fantastic job on the chat, but I'm happy to take more questions as if there's something you missed or there's something you thought of as well. So let me first turn to Claudia. So I think one of the main themes that you were mentioning across a number of your comments was additional heterogeneity that can be driven by sectors. And the path we took in this paper, at least as of now, is that we did not go deeper into interesting differences in the sectors, but instead we control for sector time fixed effects in most of our regressions. So the regressions I was showing you were more in line of the standard labor market. So when you only have when you only have worker, firm, and time fixed effects. But in the appendix, we have added to these a sector time fixed effect and a region time fixed effect. Now, the sector time fixed effect, what it's going to give you is that it will help you address a couple of the comments that both you and some people in the chat have raised. So if there are changes in the unionization, lots of those unionization changes are at this industry level. So the industry time fixed effect is going to take care of that. If we are afraid of, concentration of small firms more in one industry than the large one, again, the industry time fixed effect is going to help us with that. So we will be comparing small and young firms in the same industry in the same time and really leveraging of that heterogeneity. What this means is that the results that are there and they are in the appendix, the reason why in the appendix that they look remarkably similar to what I presented today. But what these results are giving you are still their average effects. And I'm really, I completely agree with the fact that it might be very interesting to unpack this fixed effect and show you what different types of industries, how they're different, whether we can, have a proxy of industries that have stronger unionization than others, industries that are more dependent on export than others. And we can maybe unpack it as an additional heterogeneity and we can flesh out some of those results. Right now, those things are controlled for, as I said, these are the average effects, but that's definitely something we can go down the line. A few more things I wanted to touch on. So wage rigidity, that's an interesting thing. I talked about this with a couple of people who are more in labor. So my understanding is that wages are primarily renegotiated annually. And so because our data comes annually, there should be some movement at the frequency that we're measuring. Instead, what I've seen other people doing, that even if they have more higher frequency labor market data, they actually prefer to aggregate it on the annual level because there is a rigidity, say month to month or quarter to quarter, and you would only see potential changes in wages on a yearly frequency. So that's the frequency that we work on. How to reconcile these two results? That's a really interesting question. So the way we think about it is that it really seems that the backloaded wages is the first mechanism that comes through, that really the incumbent workers benefit more than the new hires. Now, within the new hires, there is a positive effect as well. So right now, the paper and the way we set up the empirical strategy is really about the relative effects, who benefits more than the other. But what you can see, is that it seems that the labor market generally tends to benefit from the monetary policy softening. And again, this is not a question I can answer, 100% with our setup. What we are really after in this paper is to document the additional heterogeneities as this labor market is improving. Yeah, so those were on the fixed effects. The wage rigidity is also really interesting. So sorry, in terms of the interest rate cuts, and I think that was one thing that Dominic was also discussing a lot in the chat. So we checked for asymmetries, and from our analysis there, it seems that our results are largely holding for interest rate cuts as well. So they are symmetric. Now, what do I mean that they are symmetric? I'm not going to say that a cut in interest rates is the increase in interest rates is cutting wages. What I mean by symmetric is that the disproportionate difference between small and large firms, the heterogeneity is similar when the rates go up and when the rates go down. So I have lots of colleagues that work in downward wage rigidity, and that's definitely true in our data. What we're saying is that if that happens, that the difference in how rigid the small and large firms are is very similar to how they react when the monetary policy softens. So that's one thing there. The wages are real, by the way, just to comment, but it doesn't really matter because our regressions have time fixed effects. So even if you had the nominal wages, that the fixed effects would essentially make them real.
Thank you. I'll maybe just add a comment to what you were just saying about looking at that that heterogeneity and the way in which the transmission might be different with these different factors. And observe, I know many of us are employed by various central banks. When we think about the generalizability of these results to different countries, or in really interested in just the distinction between an academic journal, I would encourage you at least to maybe have a really long appendix, because I think often we really are extremely interested in those types of questions, not just what's cleanly identified after you have the great controls, but what the real impact will be depending on the extent to which other countries would be different, or there's been evolution over time in things like unions or cyclicality of industry. So we can use what is a really a fascinating paper. If anyone wants to raise their hand and ask a question, otherwise there's a lot of in the chat about asymmetries, and I didn't know if there was anything you wanted to add on that topic in general.
I think generally, so first of all, thanks for the suggestion, Anna. Very well taken. I completely agree. I saw that Linda in the chat also asked about whether we can unpack. We control for the business cycle heterogeneity. We have it estimated. We can tell more about it as well. So there are lots of things we can definitely flesh out. Right now, we suffer the opposite problem. At some point, the paper had somewhere close to 100 pages and 70 tables, and we are trying to slim it down, but we are happy to bring it back whenever there's demand for it.
Papers, that's the way to go. Make it two.
Exactly. The rigidity is something I want to look at. So for now, what we saw is that the results are symmetric. So as I said, again, I don't want to speak to aggregate effects because I'm completely sympathetic to the rigidity being a real thing, and the wages don't fall as much as they rise. What we are after in this paper is that the heterogeneity is similar in the tightening as in the softening.
Thank you. So I believe the next element on the program is a break, and I just wanted to thank very much all the presenters and the discussants. I think we all learned a lot from the papers and the discussions and the questions that were raised. So thank you.
And thank you, Anna.
It's so great that we are filming this event, because yesterday it was some of the events were so early that but then I was able to watch them on YouTube. It was great.
Fantastic. But indeed, I think many people watched it on YouTube afterwards.
Yeah, we had some really good stuff yesterday also. Huh?
Yeah.
It's good. So we can already watch it. It's up immediately. That's great.
Yeah.
I think Lydia was mentioning we have something like 1,000 views already.
How many?
Nearly 1,000 when I looked this morning.
Oh, wow. So Lydia, I just sent you, I hope I just sent you my slides just in case. I mean, it should work. It should work.
I have your slides. So if you sent them to me as a backup, that means nothing will go wrong.
Yeah.
Okay. All right, we're going to close the breakout rooms now, and we'll be ready to start on the dot of 2:45. Okay.
Great. So good afternoon, everyone. I see we are all back in the main room, so we can now start the last session of the conference, which features two fascinating papers on topics of particular interest to central banks. So as you know, the plan is to have 30 minutes for the presentations, 15 minutes for the discussions, and 15 minutes for Q&As. Please keep your camera on if possible, and feel free to ask questions by writing in the chat during the presentation, or just wait until the end of the discussion and then you can raise your hand or just jump in and ask all the questions you want. So without further ado, I will now leave the floor to Chiara Scotti from the Federal Reserve Board, which will present the first paper of the session. Chiara?
Yes, I'm here.
Great. Okay, and we can see your slides.
Can you see?
Yes.
Okay. Well, first of all, let me just start, by thanking the organizers for this great conference and for including the paper. It's been an interesting couple of days. So the paper I'm presenting today is called Words Speak as Loudly as Actions, Central Bank Communication and the Response of Equity Prices to Macroeconomic Announcements. It's joined with Clara, who I believe should be on the call today with us, and then Ben, who used to be an RA and is now a PhD student at Yale. Of course, because we work at the Fed, the usual disclaimer applies, and these are only our own views, and they don't reflect the views of the Board of Governors or its staff. So I'm just gonna give you one slide with basically the idea of the paper, so that, for those of you who, is after lunch or before lunch and you're tired, you can just take a nap. Hopefully not. So the idea is that there are a number of papers in the literature that have already studied the fact that asset prices respond to macroeconomic announcements. And this impact, this effect, is actually changing over time. And so if you look at the red broken line on the figure to the right, you see that it goes up and then down and then up again and so on. And so the idea is to try and understand what can explain this time varying response of equity prices to macroeconomic news announcements. And in the paper, we'll try to convince you that the FOMC sentiment index helps to explain this time varying impact. The FOMC sentiment index is represented in blue in the figure to the right, and we'll explain to you later, of course, how we compute it. But just to give you a short summary, it's basically we basically run a textual analysis of the FOMC statements, and what comes out of that is this FOMC sentiment index. The second part of the paper, given how important this index is for us in explaining this question, the second part of the paper tries to understand the properties of the FOMC sentiment index. And in particular, we find that it is a good predictor of upcoming FOMC decisions. It complements asset price information, and it affects the midsection of the curve, suggesting that it may contain information about future economic activity, but also monetary policy stance. And then we also find that it affects market participants' expectations about the future state of the economy. So in the remainder of the presentation, I will tell you a little bit about the FOMC sentiment index and the other data that we use. I will try to give you more information about the first question, the reaction of equity prices to macroeconomic news. We will then cover the question of the properties of the FOMC sentiment index. And if I have time, I will tell you a little bit about the robustness that we do, and then I will conclude. So the FOMC sentiment index, how do we construct it? We develop a user-defined dictionary with topic keywords, modifier keywords, and phrases. We separate the topic keywords and the phrases into 5 topics, and these are labor, output, inflation, financial conditions, and future monetary policy. So, I take it that all of you being economists, you have read, an FOMC statement at least once in your life. And so, you know that these are the topics that, are covered in the FOMC statement. And so, for example, if you look at the table to the right for inflation, for the category inflation, we have keywords, topic keywords like inflation, price, and costs. For labor, we have employers, employment, job gains, job losses, labor, hiring, and so on. So the idea is that based on the relative frequency of the words that are used in the FOMC statement, we come up with this topic keyword dictionary. And so if you look to the right, for example, for inflation in red, you see the keyword counts for the keywords that refer to inflation. And again, we basically search for the keywords with the highest frequencies, and these are the ones that we use. We do the same for output, for labor, for and for the other categories. One thing that, for example, you may start to notice is that we have a very high count for inflation in the period, in the expansion period between after the financial crisis, and then we also have a jump at the end of our sample with the COVID pandemic. Well, for example, with labor, you see that it was hardly mentioned in the beginning of our sample, while the count increases a lot after the GFC. And so, given the predictable pattern of the FOMC communication, we can actually generate a very representative set of keywords and phrases. In particular, we have 7 keywords for labor, 18 for output, 3 for inflation, 3 for financial conditions, and then we have 24 phrases for future monetary policy. So what do? We take each of the topic keywords and we match it with the closest modifier within a sentence to create the topic modifier pair, to which we assign a score of -1, 0, and 1 according to whether they're positive or negative, basically. So let me give you a couple of examples. If in a sentence we have low employment, unemployment is our topic keyword. It has a negative connotation, so it has a -1 value. The modifier low also has a -1, so that low unemployment, is a good thing. And so at the end, multiplying the 2 -1s, we have a +1 as a score of the topic modifier pair. another similar sentence, a similar phrase, labor market conditions deteriorated. Labor market condition in this case is a +1, deteriorated as a negative connotation is a -1. And so at the end, we get the score for this phrase as -1. We also evaluate future monetary policy phrases, but in this case, instead of using this topic modifier combination, we actually look at phrases in line with the narrative approach that has been used in the literature. And in the same way, we give a score of -1, 0, and +1. So once we have scored all these topic modifiers and phrases, we can compute the topic sentiment index. So for each topic, say for inflation or for labor, we can sum across the modifier scores divided by the standard deviation of the number of words in the statement to get the sentiment index for that particular topic. And so in the right, for example, you can see in the top panel that you have the one for output, labor, and inflation. And then in the bottom, you can see financial condition and monetary policy. But then in the bottom, in red, you can also see the overall FOMC index. And this is simply computed, as stated to the left, as the sum of the topic sentiment indexes. We cover the sample from January 2000 to December 2020 when we compute the sentiment index. However, in the analysis that follows, we will stop in 2019 because 2020 was a very particular year with the pandemic, although in the robustness, we actually include the COVID period, and I can tell you a little bit more about that later. We have a number of other data. I will briefly tell you about them. First of all, we are computing the response of equity prices to macroeconomic news announcements. For equity prices, we use the intraday data on the E-mini S&P 500 future contract, bid and ask quotes from Thomson Reuters. For macro news surprises, we are using surprises from Bloomberg. We use both the real-time and the real-time expectation and realizations from Bloomberg, and we use 4 particular macroeconomic announcements: non-farm payroll, initial jobless claims, ISM manufacturing, and the Conference Board Consumer Confidence Index. So we selected these 4, but the analysis actually goes through, regardless of which combination you use, clearly, as long as you use macroeconomic announcements that have an impact on asset prices. And surprises are computed in a very standard way as the announcement minus the expectation divided by the standard deviation. Then we have a bunch of other variables that are those that are used in the literature to try to explain the time-varying response of equity markets to macroeconomic news. Like, people say that the response depends on the macroeconomic cycle. And so we include the MBR dummy, we include the ADS business condition index, but we also look at financial measures of these, like the near-term forward spread, the excess bond premium, and so on. In trying to understand the properties of our index, we will look into its ability to forecast FOMC decisions. And when we do that, we look at the federal funds rate, but we also create a policy stance indicator, which is equal to -1, 0, and 1, according to whether basically the Fed is announcing tightening, neutral, or accommodative policies. And this is just because, as you know, the last 20 years don't only have conventional monetary policy, but also unconventional monetary policies. And so using the federal funds rate, we would not be capturing the unconventional policies. And then we have data like GDP, inflation, unemployment, and measures of expectation and surprises related to the target and forward guidance components of monetary policy. So the first question that we ask is, what can explain the time-varying response of equity prices to macroeconomic news announcements? There are 2 opposing effects of good and bad news on equity prices. These 2 effects are the cash flow effect and the discount rate effect. The cash flow effect basically is just saying, you know, when there is good news, things are looking up, things are good for companies, and this has a positive impact, and good news has a positive impact on equity prices. The discount rate effect is a little bit more trickier in the sense that it can depend on whether the FOMC is likely or not to increase interest rates, but it can also depend on the compensation for risk. And these two have different signs. And so because of this, the prior literature suggests two possible predictions in terms of the effect of good news on equity prices during bad times. There is a part of the literature that says good news has bigger impact on equity prices during bad times, and another part that says good news has lower impact on equity prices during bad times. I'm not going to go through, you know, all the different cases, but you can find them in the appendix of the paper. But I'm just going to try to explain you where, you know, these two different predictions come from. So one is the fact that good news has bigger impact on equity prices during bad time. And, you know, clearly the cash flow effect is positive in this case because there is good news. But then it's also true that if there is good news, the Fed is more likely to increase interest rates during good times. But if we are in bad times, the Fed cannot or does not do much. And some, you know, they cannot do much is because of the effective lower bound. And so, you know, these explain the fact that basically the cash flow effect is the effect that prevails. And so good news has a bigger impact on asset prices during bad times, you know, according to these papers and to these predictions. The second one is the one where good news has lower impact on equity prices. And this is based on Veronesi 1999 paper. And his idea is that when there is good news during bad time, this increases uncertainty because, you know, you're in bad times, but you're having positive news and you don't quite know what is happening. And so the way that risk-averse investors react to this is by requiring a higher compensation for risk. And so in this case, the discount rate effect dumps the cash flow effects, and so you have a smaller response to news. So this is just to give you an idea that, you know, many things can happen. What we find is more in line with the first idea, so the bigger impact on asset prices. And to compute the time varying effect, we run this regression where the RT is the return, the 30-minute return on S&P 500 prices that I told you about. And then on the right-hand side, we compute the response by allowing it to change, you know, over the year, so year by year, but also over the 4 announcements that we look at. And the figure that I've already shown you, the red line, is basically the year by year average across the 4 coefficients stock market response. And you can see that it tends to increase during recessions, but it is still high after a recession, and then it goes down during an expansion. And so to us, the idea that, you know, the response of equity prices to macro news is high during recessions was not, you know, satisfying, because this is not what we find. And what we find is that the FOMC sentiment index that we computed is actually mirror image of this. And so I know that people are not satisfied with just eyeball econometrics. And so what we do is we actually try to figure out the importance of the sentiment index by augmenting the regression that we showed you before. And what we do is we include a number of covariates, a number of other explanatory variables that you can see basically in this table on the right. And one of them is our FOMC sentiment. So in the paper, we try one by one, you know, we have different combinations. Here, we are just showing you a horse race. where we include the FOMC sentiment with, some of the other variables, or even like all of them. What you see is that a positive surprise has a positive impact on equity prices, but then when it is interacted with our FOMC sentiment, the FOMC sentiment actually lowers, a positive FOMC sentiment lowers the stock market surprises, the stock market reaction, and it lowers the equity prices by about 0.4 percentage points, with the idea that the FOMC sentiment, and the FOMC sentiment actually survives a bunch of other explanatory variables, with the idea that it contains information over and above the information that is already included in asset prices. The second part of the paper, as I told you, is about trying to understand what the FOMC sentiment index is really capturing. And we do so with answering three questions. The first one is whether the FOMC sentiment can forecast upcoming FOMC decisions. The second one is whether interest rates respond to FOMC sentiment. And then the third one is whether investors revise their beliefs about future economic activity after reading the FOMC statement. In terms of trying to understand whether the sentiment can forecast FOMC decisions, as it is standard in the literature, we estimate an ordered probit model, where the dependent variable is the policy stance dummy, which is equal to -1, 0, 1. And then on the right-hand side, we have, a bunch of other explanatory variables that we've already talked about. Clearly, there is the unemployment rate gap, there is the inflation rate, like the traditional Taylor type rule variables, plus a number of other variables. So if you look just at the first column, and then I'll tell you briefly about the others, we estimate this on the 2000 to 2019 period. And the first coefficient is 0.128 is basically telling you that a 1 standard deviation increase in the FOMC sentiment increases the probability of tightening by the Fed by 0.13. And interestingly, this is surviving even when you include all the other variables. Column 2, 3, and 4, maybe we'll cover them in the robustness if we'll get there, but the basic idea is that we are just trying different samples or different variables, like we actually tried using just the federal funds target rate, and the results is pretty much similar. The second question that we wanted to answer is whether interest rates, whether the FOMC sentiment index affects interest rates across maturities. The prior literature has shown that monetary policy surprises affect short and long-term interest rates. And in this case, we want to see whether there is some value in the textual analysis information as it is summarized by our FOMC sentiment index. And so what we do is we run a regression where we have on the left-hand side the 30-minute change in yields in either 3 months, 6 months, Euro-dollar, 2-year, 5-year, 10-year bonds. And then on the right-hand side, we have the target surprise as done in the literature, but we also add our FOMC sentiment index. And what we find is that, in agreement with what has been found in the literature, the target rate surprise affects these yields, these rates, but we also find that the FOMC sentiment index survives and has additional information in addition to the target rate surprise. And in particular, while the target rate surprise has more information, let's say in the shorter part of the curve, our FOMC sentiment index has bigger coefficients in the mid part of the curve, and is particularly correlated with the euro dollar. And so this is suggesting that the FOMC actually conveys more than information about current monetary policy decisions. The third question that we try to answer is whether investors revise their beliefs about future economic activity after reading the FOMC statement. And so the idea is that when the Federal Reserve is announcing a monetary policy decision, the shock is not just an exogenous interest rate shock, as it would be in the regular in the monetary policy VR literature, but it also contains some information about the state of the economy. And this is the so-called Fed information effect. And so similar to this literature, we compute the change in the blue chip forecast for GDP, unemployment rate, and GDP deflator from 1 month to the next, but averaged across the different forecast horizons. And we regress that on the target rate surprise, on the past surprise, as is done in the Fed information effect, but we augment this with the FOMC sentiment. And then we also include the news that are released, over this period, which is following a paper by Bauer and Swanson, where they actually find that once you include this news, you're basically sort of canceling out the importance of the target surprise and past surprise. What we find is that even if you include just target surprise and forward surprise in our sample, they don't have any significance. But we find that the FOMC sentiment is actually significant in forecasting the blue chip revisions, and in particular, the sign is sort of the sign that you would expect in the case of this Fed information effect, in that a positive target rate surprise is associated with a positive revision for GDP, say, which is what you would expect if basically you think that the Fed is increasing rates because the economy is doing great, and so if you think that the Fed is actually delivering information about their view of the economy. So just to summarize, given what we've looked at so far, what is the FOMC sentiment index really capturing? Well, it offers a reading on current and future macroeconomic conditions that will affect future FOMC decisions. A bullish rate on the economy implied by a high FOMC sentiment suggests that the Fed will raise rates. And so with this Fed expected with raise rates in the immediate future, when the FOMC sentiment is high, we obtain our result that the response of asset prices to a positive macro news decreases because the cash flow effect is being offset by the discount rate effect. So I have a couple of minutes, so I can tell you a little bit about the robustness. So we tried a number of different specifications in a number of different ways. So the first one is what I was already showing you when I showed you the FOMC decision prediction. So instead of looking just at our monetary policy stance, we looked at the federal funds rate, and we also looked at taking out the ELB period. A second thing that we did was we actually presented the results to you by using the overall FOMC sentiment index, but we also did the same with the subcomponents of the FOMC sentiment index, and results pretty much follow through. I mean, I have results in the appendix if any of you is interested, and I can show you that. We also tried to use alternative dictionaries. For example, there is the Logan-McDonald dictionary that has been used quite a lot in the economic and financial literature. However, we find that it doesn't work as well as our vocabulary, our dictionary, and this is because clearly FOMC communication, FOMC statement communication is very, very specific. And so the Logan-McDonald dictionary is not good at capturing those little variation that we pick up. We also try, instead of summing across the various topic indexes, we try to compute the first principal component. Results go through, but we find that the summation across them is actually more powerful than looking at the principal component. And then we look at the COVID sample. So as I mentioned, I mean, we only have, when we did all the estimation, we only had data until the end of 2020. And so we practically had a few months of the COVID pandemic. You have very big changes, huge standard deviations. Our results go through, but they are not as strong as before. Like everything is significant, but it shows that during the COVID sample, things might be different. And the reasons why they might be different, is because it's either a big shock, is because, it's putting together supply and demand, or also because, especially at the beginning, COVID was really affecting the smaller firms. And with our S&P 500, we are capturing, bigger firms, or all of the above, and, possibly even alternative explanations. So let me just conclude. In the paper, we constructed an FOMC sentiment index. We find that macro news has a bigger impact on equity prices during bad times, as they are described by the FOMC, rather than as described by other macroeconomic information. The FOMC sentiment index is an important predictor of these FOMC decisions. It complements target rate surprises, and professional forecasters revise their belief about future economic activity after they read the FOMC. We think that these results are useful in that they help to shed light on the two opposite predictions regarding the time variation of the effect of equity prices on macro news announcements. They highlight the importance of the text of the FOMC statement and the importance of communication. And also, while we find that there is evidence that the FOMC channel prediction is dominant in our sample, it doesn't completely disqualify the Veronese 1999 theory, especially when we look at the very last year with the COVID and all the uncertainty associated with it. And that's it. Thank you. This concludes my presentation.
Thank you very much, Chiara. So now we will let Silvia discuss your paper.
All good? Is it full screen? Okay, cool. So first of all, I want to echo what was said earlier and thank Caterina and Hélène for inviting me to discuss this really nice paper, and also more generally for allowing me to be part of this beautiful event. And I really hope that this is the first of many more, and hopefully in the same place. I should also say that obviously the usual, I only speak in personal capacity, the usual Bank of England disclaimer applies. So I'm not going to spend too much time in summarizing the paper, given that Chiara did an excellent job at that. But let me just bring back the punchline. So what the authors do in this paper is trying to characterize the reaction of equity prices to macroeconomic news. and how they, and in particular, to say something about their state dependence. So this is obviously not a new question, but what it's novel here is the way in which they go about providing an answer to it. And the way they do it is by using textual analysis to construct an FOMC sentiment index that captures the FOMC's view about the macroeconomic outlook. Then what they do is essentially using this sentiment index as effectively a business cycle indicator in regressions of equity returns on macroeconomic surprises. And their main result is that equity turns out to be more sensitive to news in bad times, but not just in bad times, but in bad times as captured by the sentiment index. Really, this is a chart. I mean, as you've seen it before, this is the chart that summarizes the paper. So you have in red the time-varying sensitivity of equity returns to macroeconomic surprises, and in blue, their overall FOMC sentiment index. And it's quite clear here how there's a neat negative relationship between the two, which is the main result of the paper. So in terms of contribution, what they really highlight and stress in the paper is that when it comes to analyzing the state dependence, what's relevant is not quite just where the economy is, but really the interpretation of it that the FOMC gives. And they do this by, they offer a lot of robustness in the paper, and by showing in particular that the sentiment index survives competition with essentially all the indicators that you would normally use in this type of exercises. Why that is the case? They argue in the paper that this is so because the sentiment index is linked to future monetary policy in a way that simply other indicators aren't. And then these allows them to sort of shed light and discriminate amongst potential, different theories that play different weight on the channels that help shaping the response of equity prices to macroeconomic news, and in particular, cash flows, rates expectations, and risk perceptions. Their results sort of align and give more weight to this interpretation that it's really the FOMC intentions playing the biggest role. Although, as Chiara mentioned at the end, this might possibly be not completely true during the COVID years. There might be sort of a risk consideration may have become a little bit more prevalent. And if I could add to that, it wasn't completely clear to me that this interpretation sort of holds, particularly during the years in which the Fed was implementing calendar-based forward guidance, because you could argue that if those statements are credible, uncertainty. So I wasn't clear exactly how those years fitted in the picture. So it'd be nice to have a little bit more color on that. But what I really would like to do in this discussion is to spend a little bit more time in thinking about the information content of the index that they construct. So the sentiment index is really a measure of the FOMC's consideration about growth, labor market, inflation, and financial conditions that help explain, that help really shape the current decision and obviously inform also the upcoming monetary policy stance. So, when I read it, I couldn't help but thinking that this is really a direct measure of that helps summarize the Fed's reaction function and its inputs, right? So if you think about the simplest possible representation of this, where say IT is your monetary policy indicator, say the federal funds rate or a shadow rate, if you want to take into account unconventional policy, this is determined as, using potentially time-varying reaction function, which is in itself a function of an array of forecasts that the FOMC makes about these variables like labor market, inflation, financial conditions, conditional on information at time t and all the way up to some relevant horizon h, plus a monetary policy shock. And when I saw this, I thought, I mean, you can blame this on anchoring bias, given like the work that I've done, but I thought this is exactly a proxy of the Fed information effect, right? So why is this? I mean, for those of you that are not familiar with this literature, this is is a phenomenon whereby a monetary policy decision delivers also to the public information about the state of the economy. Why is this important? It is important because at the time of the announcement, the only observable is IT. You only observe the decision, but you cannot really, the two components of it are both unobserved, right? So the public sort of needs to distinguish between these two. And that's important because these two components have very different effects on both expectations and macroeconomic aggregates. And the literature has tried in different ways to disentangle these two. So, for example, ex post, the paper by Marek Jaroshinsky and Peter Karady, they've used the high frequency theory implied co-movement between stock and bonds around the announcement to disentangle the two. And worked with Giovanni Rico, we have tried a different route complementary to that one, which was to approximate this term here in between parentheses using the Fed's internal forecast under some mild assumption on sort of slow moving changes in the reaction functions. But what it looks, I mean, what it seems to me is that this paper is really giving us a direct way of quantifying the content of the statement, and so effectively a direct way of estimating the content of this red element here. So does this interpretation make sense? What would you expect to happen for this interpretation to make sense, for the sentiment index to be a proxy for the information effect? Well, the first thing that you'd expect is obviously that it should matter for the upcoming monetary policy decision, right? Because it's literally the systematic component of policy, right? And this is exactly what the authors find. So this is a selection of the table that was showed earlier. And what you see here is like when, improving outlook as captured by the sentiment index is associated with a higher marginal probability of a tightening. Plain and simple reaction function, right? So that's the first thing that you'd expect. The second thing that you'd expect to happen is that the yield curve reacts to the information at policy relevant horizons. And again, this is something that the authors show. Now here I've sort of taken the liberty to rearrange some of the tables, sorry about that, but I just wanted to highlight how the coefficients change in different specifications. So these are regressions of interest rates at different maturities from 3 months to 10 years. On the sentiment index. In the first row, you have the coefficients that come out from a univariate regression that includes a constant. In the second row, you have the coefficients that come out of the same regression when you also control for short-term rate expectations. And what you see is that obviously the whole curve responds to that information, but once you control for expectations about the short-term interest rate, what really loads on this, on the content of the sentiment, the leftover sort of the residual power is really loaded up by interest rates at medium to long maturity. And again, I mean, for those of you who are familiar a little bit with this literature, if this reminds you of the path factor, say that the Gerkanak and co-author build, it's because it's exactly the same intuition, right? The only difference is that in that case, Gerkanak and co-authors used the high frequency reaction in interest rates at different maturities to capture the content of the statement, whereas in this paper, the authors use the content of the statements to capture the content of the statement, right? So it's exactly the same intuition, but using a different metric. And in fact, so you would expect the two measures to sort of to share a large degree of overlap, and in fact, the authors note in their paper that there's a high correlation between these two. The third thing that you'd expect is that private forecasters update their information set once that information is released. But not just that, you would expect that they update in the same direction. Okay, so, and this is again something that the authors find. So you see it here in the first row for GDP, the unemployment rate, and the GDP deflator. So here, what we see quite clearly is that better conditions, as defined by the sentiment index, lead private forecasters to revise their forecast for GDP and inflation upward, and their forecast for the unemployment rate downward, right? And what I really want to stress here is that these are better conditions that are linked to higher rates. We just saw that, right? So this is really where this confounding effect of the information effect comes into play. And what I thought was actually quite neat here as well is that, incidentally, what the authors show here is that once you control for the content of the FOMC statement, this sort of Fed reaction to news interpretation sort of loses a lot of bite. So what's missing to complete the picture? What's missing, in my view, is that you'd expect finally this measure to help you recover monetary policy shocks empirically. And I would have loved to show you this in the discussion today, but unfortunately I wasn't able to get hold of the data from the authors. But my intuition here is that they are providing us with a direct measure of central bank information, which we can use in a variety of different settings, is alternative and potentially complementary to what the literature has done, is novel, is parsimonious, and allows to condense information about many variables at different horizons, and it could potentially lead to novel insights. So, but unfortunately, this sort of remains an open question that I hope that the authors would consider answering in the future. So just to conclude, the paper proposes the construction of a sentiment index, which is a direct measure of the information about the state of the economy that the FOMC releases to the public at the time of the announcement. I suppose my main comment is that potentially the current news as a business cycle indicator is maybe restrictive, although we do gain interesting insights on the time variation of the reaction of the stock market to macroeconomic news. But where I do think that this could really broaden the scope and the contribution of the papers to really explicitly introduce it as a proxy for central bank information. Thank you. That's all I have.
Thank you, Silvia. This was a very insightful discussion, and it is fascinating, your idea of connecting the FOMC sentiment index to the central bank information. I thought it was a great idea. But now I will let Chiara reply, and meanwhile I open for Q&A. So please don't be shy and raise your hand if you have questions while Chiara replies to Silvia.
So Silvia, first of all, thank you very much for the great discussion of the paper. Just wanted to make sure you did not ask for the data. Did we not respond to you? You did ask for the data. I don't think we ever received.
Twice, but it's fine.
I never received the email. So
it's
okay,
fine. But it's okay. It's fine.
I will check in my junk folder to make sure that. Okay, apologies for that. I would have loved to see what you did. First, your mention about the calendar-based forward guidance. We thought about that, and in fact, it's buried in a footnote. But when we compute the analysis, excluding the ELB period for us is exactly the ELB that counts the calendar-based forward guidance exactly for the reasons that you mentioned. And results go through. So, you know, we are pretty confident that that is not, you know, too big of a problem. So the way that you're reading the paper is exactly, you know, what we had in mind, in the sense that, you know, we started with this question, but then when we found how powerful the index that we constructed was, we started to analyze, you know, the different pieces. So perhaps, yes, the paper could have been written in a different way. But I guess Clara and I, you know, started with a different kind of question, but we got more or less, you know, exactly to, you know, where you thought that we would get in terms of trying to figure out the information contained in the index. And it's exactly, you know, a way to summarize basically all the information about the economy as it is seen by the FOMC. And so in a way, it does contain, you know, information, you know, the so-called Fed information. And in fact, you know, we sort of checked all the boxes in terms of that. The idea of trying to recover the monetary policy shocks using that is a great one. I'm sorry that we didn't get your email, but perhaps we can chat offline, you know, about what to do in that regards. But thank you.
So I see that Gianni has a question, and I also wanted to ask you regarding this composite index, which has 5 different components. So which are the most important ones, and if there is time variation in the relative importance of the different components. And shall we collect questions maybe first?
Whichever way you prefer.
Answer? So it's
yes.
Gianni first and then Monica.
Hi, Chiara. So super interesting paper. I was just wondering, and I'm sorry, I had to miss the first few minutes of the presentation, so maybe I missed something important. It seemed like your interpretation was mainly through that it's changing the importance of the discount rate channel. And I was wondering if it might also be affecting the cash flow channel too. And because I noticed you do regress the revisions in forecast.
Sorry, I lost the connection at the beginning and could not hear the first part of your question. Can you start again?
Sure. Can you hear me now?
Yes.
Okay, yeah, I was saying that it seemed like you were mainly interpreting this interaction as coming from variation in how strong the discount rate channel was. And I was wondering about an alternative explanation based on the cash flow channel in terms of whether this sentiment index might also be basically changing people's perceptions of how important surprises were for macro outcomes. And so I saw you have some regressions of macro forecast revisions on this sentiment index, along with the surprise for at least NFP. Is there an interaction there too that you looked for?
Okay, maybe I'll collect everything and then we'll talk. Yes, Monica?
I was wondering whether I really like this idea of putting words that we use to describe what we see back into a number. I really like this idea. And would it make sense to look at the minutes, you know, to do this more broad, because it's sort of, I really like the fact that we see macro series, but how we interpret the macro series, it really depends on so many other things that we see. And so I sort of view this as a much more formal way of doing like a Romer narrative of what the Fed is, what we're expecting the Fed to do, and what is sort of surprising relative to the expectation. I think you can broaden this much more. I'd be interested in it.
So let me respond to the questions in the order in which they were received. The first one about the time variation in the components. So there is indeed time variation. And in fact, if you recall, like in one of the charts, I showed you how, you know, labor was not important at the beginning because we really have fewer words. And so we sort of find, you know, the same thing about the different components. We have in the robustness an analysis of the importance of different components. For example, in forecasting, in the case of the output component, forecasting GDP. In the case of labor, in forecasting unemployment rate. Same for inflation. And they're significant, but not, the combination of them is actually the best thing. And again, as I mentioned, it's actually the combination in terms of the summation of them, because it's not really one of them in particular that the Fed is looking at, as you know, it's a mixture of things. And so it's really important to look at them all together. So this is the answer to the first question. The second one is the cash flow versus the discount rate channel, and the importance of surprises in shaping perhaps the expectation of cash flows. We haven't really looked into that, and so you were mentioning in particular our regression about the blue chip revision, if I understood correctly. So we interpreted that in a completely different way. So I would have to think a little bit more about how to translate that, into our analysis, but it's definitely, something that we can look into. And then finally, Monica, yes, this is the second paper. We're already working on it. So you read our minds. I don't want to spoil any of the results because you'll have to wait to see what the paper will look like. But we've already started. It's a more complex way of analyzing the minutes, because the simple thing in a way about the statements is that they are so similar. And so, they basically use more or less the same words over and over again. And so it's easy to come up with a dictionary for the statements. For the minutes, it's much more complex. There are many things to take into account. Sentences are really, really long. They use many different ways of describing inflation. There is the view of the staff. There is the view of the policymakers. There is the view about the current economy, the view about, the outlook. So we're working on that. So stay tuned.
Great, I'm looking forward to it.
Sorry, I just want to add on a little bit to what Chiara said. I agree with everything that Chiara said. In terms of if I had to pick one of the subcomponents, it looks like output all throughout our period is something that we always mention. So there is emphasis on different topics throughout the time period, but it seems like output, if I had to choose one, output would be the one to choose. And regarding the question about the cash flow and discount rate, I'm not sure. I think I understand what you mean, but I think it's difficult to test what you're saying, because if there were only cash flows, then positive news would always have a positive effect on equity prices. So the only reason why we think it would have like a lower effect, in my view, it has to mainly do with the effect it has on the discount rate, because it's the opposite effect that the cash flow. But I think what you mean is that maybe sometimes if the Fed is not going to increase interest rates and you have a positive cash flow, then cash flow news, then maybe you think that cash flows will be even higher in the future. Is that what you have in mind?
I just have in mind that the size of the cash flow effect might fluctuate. I'm not saying instead of the discount rate effects, but what I have in mind is that this index could basically inform market participants about how important a particular surprise is. Because basically how much weight the Fed might be placing on.
So you mean if the Fed is in agreement with the surprise that you receive or something like that, then it validates the surprise?
Yeah, so like one particular example might be that for any given surprise, it could be viewed as a very transitory thing or a more persistent thing. And so this is the kind of thing that like the Fed sentiment might be indirectly revealing to markets. I actually have some research myself also using the Fed statement and minutes text, looking at just the degree to which the Fed talks about certain topics. So not sentiment, just how much they're talking about certain topics. And you do see that this influences how bond yields respond to surprises. The things that the Fed calls attention to in these statements tend to get bigger responses. And the reason I'm asking about the blue chip forecast is that you see this kind of interaction in the blue chip forecast too. So I was
Great.
just curious.
I look forward to reading your paper. Thanks, Jenny.
Thank you. I see that there is another question.
Dana, did you have a question?
Yes, I have a question. So yes, I didn't know if I had to unmute myself, or you would call me, so I was waiting. So I was wondering if more space or importance can be given to exchange rate. I know that the Fed does not explicitly target exchange rate, but during the time frame you analyze exchange rate policy was quite salient. I mean, we have seen many, public discourse, President Trump reacting to the China shock and politicians blaming China and other countries for exchange rate manipulation. And we also seen trade restrictions. So I was wondering how this, could have affected equity prices or somehow, could be incorporated into your frame. Thank you.
Okay, my answer is, being a true policymaker, that we don't look at exchange rates to determine our policy. And so, yes, Trump might have talked about that, but, it doesn't really factor into the monetary policy decisions. And so this is why we did not consider exchange rates in our analysis.
Sorry, Janet, was your question about whether it should be part of the textual analysis or whether we should have the reaction of exchange rates to news?
So I guess it makes sense. It doesn't make sense to include into the index because this is not targeted by the Fed. But somehow maybe in the framework, maybe somehow control for it, or in some way to account for the importance of exchange rate, particularly during that time period. I know that the US has a flexible exchange rate, so it doesn't really target exchange rate, but it was very salient, right? I mean, we have seen the public discourse debating the implications, and I suspect that this also somehow affected asset price, not asset prices, the equity prices, etc., stock markets concentration. So I don't know if there is a space somehow to incorporate it, to control for that, or somehow take into consideration that this was, it may have been also somehow fighting the
But so you mean instead of analyzing the reaction of asset prices to look at exchange rates?
No, I was thinking maybe just because you have, different, maybe controlling for, exchange rate or in some other way. So I don't think index would be the proper, the proper space because obviously, as you mentioned, it's not really, but maybe it's one of your controls or maybe otherwise to take into consideration this fact. Exchange rate.
Well, thank you for the suggestion. We have not. Thank you.
Okay, perfect. So I would suggest to pause now and let Monica present the next paper. And
thank you very much for having me as part of this super exciting conference. It's when I started my job, there were only men in my group, and I didn't realize how much fun it would have been if there had been more women. And so now I have the privilege of being at places like this one, where only women, and so these events are just a blast and the biggest fun. So this is joint work with Melina Papuzzi, who is at the ECB, and Martin Schneider at Stanford. What we want to know about monetary policy in this paper is we want to think about corporate bond purchases and which corporate bonds central banks should buy. So basically in the low interest rate environment, the main tool for monetary policy has been unconventional monetary policy. Central banks have been buying assets. They started buying government bonds. Then they moved to mortgage-backed securities. And most recently, they started buying corporate bonds. The goal of these purchases is to lower firms' cost of capital and stimulate investment. But that raises the question, which corporate bonds, so by which firms should the central banks buy? The conventional view on this is that monetary policy should be market neutral. The idea is that the central bank doesn't have a mandate to favor particular firms. There's no mandate to do green investment, for example. And so in practice, central banks have been implementing this idea of market neutrality by buying bonds in proportion to the amount of bonds outstanding. So if a particular company issues more bonds and another company issues less, the central bank will buy more bonds of the firm that issues more and less of the other. That's the idea. So this is how they're implemented. And so in this paper, what we want to ask is, what are market neutral asset purchases? If a central bank asks you, we want to do a market neutral intervention, how can we do it? What would be your answer? And we also want to know, is what the ECB currently doing neutral? What is optimal in a world with financial frictions and climate externalities? That's another question we want to ask. And so first, I'm going to show you some data on the sectoral composition of the ECB bond portfolio. We measure ECB holdings, the amount of bonds outstanding by European firms, and emissions by sector. And we benchmark these holdings to the market portfolio firm values. So think about the market value of equity and debt of all the firms within a sector. That basically corresponds to sectoral capital shares. And then I can compare this market portfolio to ECB holdings. And what we find is that the ECB bond portfolio looks like sector shares of emissions. It does not look like the market portfolio. So the ECB overweighs sturdy industries relative to the market. This portfolio composition reflects the way the ECB implements market neutrality. Because they are buying proportional to the amount of bonds outstanding, the ECB ends up buying bonds issued by relatively dirty sectors. The reason is that these dirty sectors, they have a lot of machinery, they have a lot of tangible capital, and so they can issue more bonds. The question still stands, are these dirty asset purchases somehow market neutral? Are they optimal? Should they be greener? And so for that, we need a model. We have a growth model with heterogeneous firms, climate externalities, and financial frictions. And so in the model, asset purchases work through liquidity and risk premium. So because firms differ by their riskiness and their emission intensity, asset purchases will affect them differently. First, through a liquidity effect, which lowers liquidity premium on firms' bonds, which benefits mostly firms that are heavily bond levered. And there's also a risk effect, which is that the purchase program takes risky private assets off of intermediaries' balance sheets. So it lowers their risk exposure and it creates more safe government debt because central banks pay with reserves. That's safe government debt. And so that lowers the risk premium on many assets in general equilibrium. So that will benefit risky firms more. What's market neutral? The natural definition of market neutrality in this setup is going to be that the intervention leaves firms' relative costs of capital unchanged. So the intervention only has macro effects. It lowers interest rates, but it won't distort the market portfolio, won't change the relative allocation of capital across firms. A market neutral policy essentially doesn't exist. It only exists under special assumptions on this model that are not supported by the data. So it's difficult to be market neutral. particular, the current ECB portfolio is definitely not neutral. It favors sturdy firms that are both bond levered and risky. In terms of what's optimal, it's optimal for the planner to design a carbon tax and to have an asset purchase program where the asset purchase program just fixes financial frictions. It's not neutral either. It would favor risky firms because they are disproportionately affected by any financial frictions. In terms of what would be good to do if there is no carbon tax, which is the world we live in, especially in the US, but also still in Europe, carbon prices are still too low. What would be beneficial is to favor green firms in these asset purchases. So that's welfare improving. Let me just briefly mention existing literature. So we definitely relate to a large literature that tries to understand the price impact of unconventional monetary policy. And then papers that think about economic mechanisms through which QE has real effects on the economy. And so the difference here is that we're looking at the cross-section of firms. We want to know, how does unconventional monetary policy affect different firms differently? And so in that sense, it's more related to the literature on misallocation. And there's some recent work that is thinking about monetary policy and how it relates to misallocation. Most of these papers have looked at conventional monetary policies, so just interest rate policies. The model I'm going to show you is going to have quality of the environment, which has effects on production. And so that feature is related based on integrated assessment models. And then there's now an exploding literature on climate finance, where people are documenting that firms that have more emissions face higher costs of capital. So this is the literature on pollution premia. And some recent papers thinking about monetary policy, how can we make it greener? And so here's the data. So we're measuring the ECB portfolio by sector, where we start from ECB securities holding statistics. These are holdings of individual bonds by the ECB. And we merge that to the ECB centralized security database on bonds outstanding by firms in the euro area. What's important here is to take care of special purpose entities, because if you look at the raw data on ECB holdings of individual firms, you'll find that the vast majority of these holdings are issued by firms in the finance sector. They make up 56% of ECB holdings, but you know that that can't be, because these bonds are ineligible for the purchase program, because the ECB cannot buy bonds issued by firms in the finance sector. So what's going on? The ECB will buy bonds from companies, for example, Royal Dutch Shell, which is an oil manufacturer. But the bonds are actually issued by a subsidiary of Royal Dutch Shell, which is called Shell International Finance BV, which, if you check the sector that Shell International Finance BV belongs to, it's the finance sector. And so what you have to do in order to attribute these bonds from the finance sector to the right sector is you have to research these special purpose entities individually. You attribute them to the right sector. And so that's what we did. And then that reduces bonds issued by the finance sector to 11%. It's hard to get any further than that, because there are some finance companies that issue bonds for many different small companies. And so it's difficult to attribute these bonds to the right sector. So what I'm going to show you is just results for non-financial sectors. And so I'm going to compare the ECB portfolio with three measures of the market portfolio by sector. The first is capital income from Eurostat. The second measure is book assets from Orbis. But of course, what you would like ideally to have is market value, so market value of equity and debt. We only have that for public companies from Orbis. But luckily, all these three measures give you the same results. So here in this talk, I'm only going to show you the first measure, but in the paper, you see all three, and the result is the same. So this is what you find. Here are market shares by sector. These are the different sectors in the European economy. On the horizontal axis, you have how big they are in terms of market share as a fraction of 1. And so you see there's the agricultural sector, automobiles. There's a big sector which is manufacturing, and then we split manufacturing into a sector that we call dirty manufacturing that has all the subsectors of manufacturing that have high emissions. And then we call everything else other manufacturing. Then there's utilities, transportation, and services. And as you look at these red bars, Europe looks like other advanced economies in the sense that the service sector is the largest sector of the economy. And so let's now compare that to ECB holdings of bonds by sector. And so what you see here is the blue bars. This is what the ECB holds. The ECB holds bonds from the automobile sector, dirty manufacturing, utility, transportation, other manufacturing. And then you look at the blue bar for services and you see the ECB holds way fewer bonds issued by the service sector compared to its market share. And so now let me show you emissions. These are the gray bars. These are scope 1 emissions, direct emissions of companies in these sectors. And so what you see is you compare the blue, the red, and the gray with your eyes. And so what you see is what the ECB is doing. It's buying relatively bonds of sectors that have relatively high emissions, dirty manufacturing, utility, transportation, and other manufacturing. And then it doesn't buy many bonds issued by the service sector, but the service sector is a relatively clean sector. So this is just looking at direct emissions. If you include indirect emissions, I have the picture in the paper. If you include indirect emissions, for example, the automobile sector here looks pretty clean according to scope 1 emissions. But if you include more indirect emissions by the automobile sector, for example, the emissions that are associated with the electricity use in the automobile sector, or you attribute the emissions from driving around of the cars to the automobile sector, then this looks much worse. And in fact, the whole picture looks worse. The ECB is then underweighing clean sectors even more. And so this is the main result. The ECB basically portfolio is overweighing dirty sectors. It's underweighing clean sectors. That's what you see in the data. And so why do I show you this by sector? This is confidential data. You can't actually look at individual bond holdings of individual firms. We wouldn't be able to do this. So here are the results by sector. Now I want to know, are these purchases market neutral? For that, I need a model. And the model we're using is a growth model with climate externalities and financial frictions. So there's a representative household with preferences over a final consumption good C. This household inelastically supplies 1 unit of labor. And so this final good C is made from many, many intermediate goods that are made from N sectors. So these N sectors, just like I showed you in the graph, there are different sectors of the economy, and there are many different varieties of goods within sector. And so if you look at how this is produced, the final good is a Cobb-Douglas composite of the sectoral goods, and each sector production is itself a CES composite out of many different varieties. How do these firms produce? They have firm-specific climate externalities in production, which means that all firms have emissions. The emissions on the lower right corner, you see the evolution of the quality of the environment. So there's an index, let's call it temperature, which measures the quality of the environment. And then there are new emissions. That's the sum of all the emissions of individual firms. So epsilon I is the emission intensity of firm I, yi is its output. And so that's total emissions of firm I. Now you sum them all up, and that pushes up temperature. So you see this unit root dynamics for temperature. That's what these integrated assessment models write down. And then there's a feedback from this temperature on TFP. So the individual production function of firm I has sector-specific factor shares, alpha, N. So that's the same for all firms in the sector. But then every firm has its own TFP, that's Z, I, which depends on temperature. So if temperature goes up, TFP will decline. That's the idea. So that's the negative impact that emissions have in this model, is a lower future TFP. But I need something else to be able to talk about QE. It's not enough to just think about emissions. I also need financial frictions, because without financial frictions, QE doesn't have any effect. It cannot have any effect. So let me introduce financial frictions. So I'm going to think of firm I selling claims to its capital stock as different securities. So these are the A bars, is securities that firm I issues. So this is the supply of the securities of different securities S that firm I here issues, and the sum is just the claim to capital. Households use two technologies to hold these securities. They either hold them through private intermediaries or through the central bank. Both of these technologies come with holding costs. So it costs something in terms of the final good, resource costs, to hold these securities. And so these holding costs capture either compensation for risk taking, or it's a financial friction. And in fact, the data later is going to help us take these two cases, tell them apart. So it's either compensation for risk, it's costly to hold claims that are risky, or it's a financial friction. It has to do with the cost of financial distress of the financial intermediary, and that generates holding costs. This whole cost function depends on holdings of the private intermediary. So the private intermediary holds these private assets, AT, that has individual holdings of securities issued by different firms. Then also holdings of central bank debt, DT. And the function is homogeneous of degree 1 in these holdings. So basically constant returns to scale technology for these private intermediaries. And it's also quasi-convex. The quasi-convexity captures that if intermediaries put a little bit in all these different securities, they're more diversified, and that lowers costs of holding these assets. So the cost function depends on the capital structure of the firms. If the firms are more levered, if they choose to issue more bonds or have more bank loans, that makes them more risky. So that increases costs. What also matters is whether firms are eligible for central bank purchases. So the subset here, I wiggle, of firms that is eligible for purchases, that also affects holding costs, because it makes it cheaper to hold securities of firms that are eligible for the program. And there's an analogous cost function for the central bank. So I'm not saying it's free for the central bank to hold assets to make these purchases. The central bank also has costs, and I'm going to denote that with H wiggle. The only difference between the cost function for private intermediaries and the central bank is that the central bank doesn't hold its own debt. That's the only difference. And so now, basically, this is the environment you're in. We have these climate externalities, and we have these financial frictions. And now I want to decentralize this. I have private intermediaries. These are competitive firms that are owned by households. They invest in a portfolio of securities that are issued by firms, and also the central bank debt, DT. And so what these private intermediaries do is they maximize shareholder value. So they have these holdings, and then they get returns on these holdings, and the returns are then multiplied by the household discount factor. That's just the marginal rate of substitution of the representative household. So that's how the intermediaries value the returns that they're making. And then they also face these holding costs. The term in pink is the holding costs that they have that are associated with these holdings. If you now think about the first order condition of security S that a firm I issues for this private intermediary, it's basically discount factor of households times the individual return on security S issued by firm I, which is equal to 1 plus the marginal holding costs that the intermediary faces in holding that particular security. And as you're comparing this with the Euler equation, the standard Euler equation for the risk-free rate, that would just be pricing kernel times the risk-free rate equals to 1, then you already see that the term in pink is a return premium. It's a premium over the risk-free rate. And so now you have firms, they hire labor, they sell goods in competitive spot markets. So they hire labor at wage W, they sell their goods at price PI. They may have to pay a carbon tax, so they maximize profits, where this is revenues minus the carbon tax, minus the wage bill, minus all the returns that they have to pay on the individual securities. And if you now look at the first order condition of these firms for capital, then it's basically the marginal product of capital minus the carbon tax, which is equalized to the cost of capital, RI, which itself is a weighted sum of individual returns on securities, where the weights are just how much of that particular security the firm has issued relative to its capital stock. If you think about the first order conditions for the individual securities that fund capital, that implies an optimal capital structure. And the way it works is that the firms are monopolistic competitors in their own security markets. They realize that when they issue security, they have an impact on returns demanded by intermediaries. If you go back to the first order condition of the intermediary, here you see that if the firm issues different securities, a bar, it will affect the marginal holding costs of the intermediary. And the firm takes this into account because it's basically the only issuer of these particular securities. And so then we make assumptions on the holding cost function so that we get interior optima for the capital structure choice. And these trade-offs basically capture the usual trade-offs from corporate finance models. Initially, it's cheap to issue bonds, and then it becomes more and more expensive, and that gives you an internal solution for capital structure. Let me just close the model. There are these final good firms. They just buy intermediate goods at price PI. They sell the final good at price 1, which is normalized. And then there's the government. The central bank buys these assets, a wiggle, and it finances these purchases with debt, which is essentially reserves. So it's paying for corporate bonds with reserves. And then the government, the consolidated budget constraint looks like this. The government pays interest on past debt. It has holding costs itself. And then it also makes returns on these assets and raises a carbon tax. So everything else that is left over gets rebated lump sum. So let me talk about the allocation of capital in this economy. How much capital firm I gets determined from this equation, which says that the marginal product of capital is equal to the cost of capital, which itself is this weighted sum of marginal holding costs that intermediaries face. In the frictionless benchmark, so if holding costs are just risk compensation, central bank purchases don't matter. That would be the case where total holding costs in the economy, so private plus central bank holding costs, are independent of how many assets the central bank holds. And they're also independent of the eligible set of firms. So here, what the central bank does doesn't matter because we don't have any frictions, then it won't be, the central bank has no way to affect the cost of capital of individual companies. With frictions, a company that has high marginal costs will have inefficiently low amount of capital. So there's misallocation. And so now the central bank has a role. It has 3 ways of influencing costs of capital. The first is to just take firm I risk off of private intermediaries' balance sheets. So the firm I has issued some amount of securities, A bar, the privates are holding A, and so if the central bank buys some of these assets, it will reduce what the private intermediaries are holding. It can replace these risky securities with safe government debt D, and it can also improve the liquidity of firm I bonds by making them eligible. So you see that all these terms enter the marginal holding costs. And so if the marginal holding costs represent frictions, the central bank has a role to play. How would you define market neutrality in this world? Our definition, which is natural in this model, is that, well, a market neutral policy should not affect relative costs of capital of different firms. So the ratio of different costs of capital should stay the same. So that means that you're not affecting the market portfolio. You're not distorting capital across different firms. So you start from a laissez-faire equilibrium with zero government intervention. You do a comparative static to an equilibrium with a central bank purchase program, which has positive amounts of debt, central bank debt. And so the market portfolio should not change in equilibrium. That's market neutrality. Is there such a market neutral central bank portfolio that can achieve this? The answer is generally no. There are two key sources of non-neutrality. First, the central bank purchase lower the liquidity cost on bonds. That favors more bond levered firms. And the second is that the central bank basically takes off risky private assets off of balance sheets from intermediaries, replaces them with safe debt. In general equilibrium, that will lower risk premia and that favors more risky firms. Is there where these sources of non-neutrality are shut down? For example, here's an example where you would get neutrality. Suppose all firms have the same bond leverage. That's not true in the data, but let's say they all had the same bond leverage, or you allow the central bank to buy stocks. And the second is that the markets for private securities and central bank debt are completely segmented, which means that there's some intermediary that holds the private securities and another intermediary that holds central bank debt. In that case, the costs are just the sum of these costs of individual intermediaries. So the cost is separable in these two types of securities. That's when you get non-neutrality, because the more debt will not affect the premia on the private securities. This is a very special financial system. It's not in line with the data because we know that QE mostly works through risk premium. So this is not the world we live in. So the upshot is that it's not possible to be market neutral. These policies will always affect the cost of capital of firms. How do I think about the cost of capital for firm I? There's an effect to the risk-free rate, which is the same for all firms. Then there is an effect on liquidity premia on its bonds, if it has issued bonds. Those get multiplied by the amount of bonds it has as a fraction of capital. And then there's an effect on risk premia on different securities. So let me think through ballpark numbers based on the response to the 2016 ECB program where it purchased corporate bonds. My co-author has a paper, a very nice paper, that shows that liquidity effects on bonds are very small. Basically, comparing eligible bonds versus non-eligible bonds with the same rating gives you a very small effect on the liquidity of these eligible bonds, basically 15 basis points. Then you have to multiply that by 10% of a bond share. So the overall number is small. So it's not working through liquidity. QE is working through risk by changing risk premia. So how can we think about this? There's a paper by Todorov that documents that bonds with a 1 percentage point higher bond premium fall during this program by 50 basis points more. There is work by Bolton and Kirkpatrick that firms with 1 standard deviations higher emissions have 4 percentage points higher risk premium on their stocks. So this is a pollution premium. If you assume that firms have roughly 25% total debt financing, so not just bonds, but also bank loans, that 4 percentage points translates into a 3 percentage point higher cost of capital for these high emitters. So then I can say, well, the cost of capital of firms with these high emissions, because they have these higher cost of capital, because those fall more, they will fall by 1.5 percentage points more than the cost of capital of clean firms. With then standard parameters for the capital share and the elasticity in this model, I get that firms with 1 standard deviation higher emissions benefit because they can produce 1.5 percentage points more output and emissions. So the program was generating more emissions. We can also talk about optimal policy, but I'm running out of time. Basically, the optimal is to have a carbon tax and to fix frictions, and that means benefiting mostly risky farms. So what I showed you is that the ECB current portfolio looks like the sector shares of emissions. It doesn't look like the market portfolio, which is because the ECB overweighs dirty bonds issued by dirty sector farms. How would you think about market neutrality? As an economist, you would define it as leaving the cost of capital relatively the same, unchanged of different farms. Otherwise, you're distorting the market portfolio. And so holding bonds in proportion to the number of bonds outstanding, we've seen that in the ECB portfolio, it's not a simple recipe for neutrality. Instead, what ends up happening is that you favor relatively risky and bond-levered farms. With a carbon tax, you would only address financial frictions as a central bank. So you would focus on risky farms, but without a carbon tax, which is the world we're in, you can think about doing greener investments, and it would be beneficial. Thank you.
Thank you, Monica. So Hélène will now discuss your paper.
Okay, you can see my slides?
Yes, we can see.
Perfect. So it's the last paper of a conference, but it's a major one. So I think it's really an important paper. And it's also extremely rich. And I think it's important on both dimensions. First of all, there is a very striking empirical finding. And second of all, there is a very nice modeling exercise here, which I think opens the door to a lot of different potential applications. And only the surface is being scratched here on what we can do, I think, with their model. So the model is a multi-sector growth model with climate externalities and financial frictions. And as you've seen, the financial friction, which is key to generate the real effects of quantitative easing, is introduced via holding costs. And I will talk a lot about those. There are climate externalities which are introduced via a direct effect of temperature on productivity at the firm level, and of course when temperatures increases with emissions. The paper first starts by clarifying what I think is very important, what is meant by market neutrality. We talk about central bank wanting to be market neutral, but is that possible? Under what condition is that possible? And it clarifies very neatly what it means within the model. And then it shows that in practice, ECB purchases are absolutely not neutral. In fact, that they are tilted towards the wrong sector from the point of view of carbon emissions. And I think it's very useful to do that because there is too often that belief that central banks can kind of magically implement monetary policy, and there's no effect on distributions or effect on, and in fact, whatever tools you use, and that was also the truth for conventional monetary policy, you have distribution effects, and here you have effects favoring some firms which are actually not either riskier or either the firm with most emissions. So I think it's very, very important to realize that it's implementation of monetary policy. If you take realistic assumptions, it's not going to be neutral. But the paper doesn't do only that. It derives optimal policy as well. And Monica didn't have much time to talk about it, but that's also a very interesting part of the paper. And shows that if you want to tackle both the climate externality and the financial friction, so you address the climate externality optimally with some specific tool, a carbon price, a carbon tax, and then you can use the asset purchases to address the financial frictions. There are also very interesting results if you're in a world where essentially the carbon price is not doing its job, which indeed may be the world we live in so far. And that as a side product, the model gives you some kind of, very nice handle on how we can model the effect of asset purchases on the real economy. And also it gives you accessorily a model of optimal balance sheet size for central banks, based on risk consideration, which is something that, that we don't have that much theory about. So I think it's also a very interesting side product in a way of the model that they are using. Now, here's the graph that Monica showed. I'm not going to come back to it. It's very striking. The ECB holdings are kind of, correlated with emissions here in terms of cross sectors, which is not great. But this is, as Monica said, based on scope 1 emissions. Now I'm going to show you, this is the second graph that you didn't show. If you actually look at emissions and you include not only scope 1, but scope 2 and scope 3, you see that it's even more striking that maybe that the central bank buys the wrong type of bonds, with the services here being very, very small in all these different types of emissions, and the dirty manufacturing or the transport being much bigger with these measures of emissions. So if for those of you who are not super familiar with that, scope 1 means that it's a direct emission due to production, scope 2 emissions due to energy used in production as well, and scope 3, it also incorporates the downstream use. So for example, if you are indeed a car manufacturer, it also incorporates the emissions of your products, right? And I mean, it does seem that it's the right measure is to use as much as possible scope 1, scope 2, or scope 3. So I was just curious because I know it's extremely hard to get data on scope 3 emissions. It's hard to estimate it, as we can guess. So here you are using some database, Ergentem, and I was wondering what your data coverage look like and how accurate you think it is, because I think ideally you do want to use that, but I'm curious on how much you cover with that measure. Now, of course, it's also an interesting empirical question. Why is this correlation between debt finance and emissions kind of positive? So why are there lots of bond outstanding from companies or sectors which emit a lot of CO2? And here the paper takes the view that it's due to heterogeneity in tangible assets across sectors, because dirty plants, utilities have lots of tangible assets. Somehow they issue more bonds. Now I'm a bit puzzled given also the session we had this afternoon with Shebnem and Maya Sunta, so in terms of collateral and things like that. So but that's an interesting, that's a plausible, hypothesis. I don't know if it's if you can actually look at it a little bit more closely in the data. Could it be due to other causes? For example, is it the case that you have some kind of substitution between bond financing and bank financing if there is a recent green bias in the portfolio of banks, maybe which are, undergo a lot of peer pressure and maybe some a bit more pressure now to green their portfolio? Could it be the case that there is some substitutions towards the bond market? I think it's a very important question in the context of course, Europe, because most of the financing go through banks. And the ECB lending programs also, there are some programs which go through the banking sector or the LTROs, etc. So these have major effects on bank financing. So if we want to understand, I think, more fully the effect of central bank policy on the financing of brown versus green in Europe, I think we do have to also to think about the portfolio of banks, and that's a bit of a key missing element here. And that brings also the interesting question, which is, if we have regulatory action on bank portfolios, asset management as well, and we start to see some of those with some mandatory disclosure, for example, in France, of the asset manager's portfolio in terms of how green their portfolio is, how is that interacting with the central bank purchase? So that's this question of substitutability of type of financing, depending on whether you are under some regulatory pressure or you are more visible, you have more transparency in disclosure for one or the other. So do we see some shifts here? And so one way maybe of having some idea, it would be also to take a look at the time series of the bond outstanding across sectors and to see whether the ones which indeed have more emissions, whether it's a stable relationship, which would point towards your type of explanation of tangible assets maybe, or whether this is a more time-shifting relationship, which maybe would reflect more regulatory pressure or more disclosure or things like that. I think that would be interesting and important in the context of Europe. Now, the theory, so it's a beautifully modeled, complicated problem here. So we have firms which are heterogeneous on 2 dimensions, risk and emission intensity. And the asset purchases work, as Monica explained, both through liquidity and risk premia. So now the liquidity premia is kind of a very targeted tool because it's going to be active only for eligible bonds, whereas the risk premia is going to be less well targeted. There are going to be some spillovers under certain assumptions, which are the realistic one. And so the purchase programs allow us the risk premia on many assets, but you are going to have bigger effects for more risky firms. So now these are the channels for which this work. I think there's another channel potentially, but I mean, that's for another paper or extension, which would be the maturity transformation, because when the central bank does QE, effectively it replaces some long dated debt or longer dated debt with very short-term assets, the reserves. And there are some striking empirical evidence by actually a PhD student who is on the market this year, Michele Andreoli, showing that monetary policy shocks have extremely different effects on output depending on the maturity structure of the debt. And his channel is also through a financial friction, which interacts with the financial accelerator effect, but it's a financial friction on the issuing market. And I think that's also quite interesting because the effects are quantitatively quite strong. He has good identification there. And so here, clearly that would interact as well. So that's potentially another channel. Now, so in the model, who buys the assets? In the model, they can only be bought by the central bank or by these intermediaries. And so the pricing of these assets will depend on the stochastic discount factor of these intermediaries, which become a representative intermediary, thanks to this very clever assumption on the holding cost function in particular. And so there is a constant return to scale in intermediation. Now, so in reality, and I think that's great. I mean, I think that's absolutely a great way of modeling what's going on. But so what we may be worried about in reality is that there are different types of intermediaries with different degrees of risk-taking or different degree of regulation. And so that would matter because following central bank intervention, some of us could be tempted to buy some of these brown assets that would now be sold more cheaply. And so I think this is something that is important. We could see some shadowy intermediaries buying brown assets following central bank action, and in a way undoing any short selling of a climate factor that the central bank could be doing. I think this is a question that is very important in climate policy because it goes back to a very broad issue of leakage, right? So how do we avoid leakage? And so here we could potentially have some if we have heterogeneity in the intermediation sector. Okay, so this very beautiful model, so there's one key function in this model, it's the holding cost. So how we model holding costs both of the intermediary and the central bank. So it's modeled in a very flexible and interesting way, which generates an interpretation for liquidity, a risk premia, and depending on the slope of this function, the slope of this function is going to give you a different sensitivity to the cost of leverage. It's going to give you also, it's going to capture also how when the central bank issue more reserves, how much that's going to lower the risk premia. So this is a very nice way of having both this different leverage and also different effect on risk premia. So the assumption that delivers the effect on risk premia on all assets relies on non-separability. The intermediary has to be able to invest on a whole bunch of assets. So there is imperfect substitutability between all those assets. If you had completely segmented market, as Monica said, this would not happen. And I think it's a very nice way of modeling spillovers and a very tractable and interesting way. And I think we do have so much more evidence now that this non-separability is important, this imperfect substitutability is important. We have evidence both actually on domestic effect of quantitative easing. We also have now evidence, and in particular for the ECB, there's a very nice new paper by Sylvia and Tsvetinenova, who shows that ECB purchases have an effect on financial conditions outside even of the euro area. So it just shows that this non-separability extends to foreign assets, which is quite striking. Now, one question is how much time variation in parameters of this H function, this holding function, should we think about? Right? Because the imperfect susceptibility of assets, very intuitively, and I think also on the data, depends on whether we are in a high risk period or low risk period. So in low risk period, assets might be very substitutable. In a low risk period, they become very far less substitutable. So there are some interesting, maybe here, time variation and cyclical variation, which are not in this paper, but could be really an interesting extension. And a related issue is this is a continuous function, but of course intermediaries also face constraints, which may lead to much more abrupt changes in asset pricing. And we do have some evidence on that for the euro area. For example, a paper by Coimbra here, who shows how important banks are to price assets, and when we stop buying assets, how the risk premium jumps up essentially. So that you can have that with model with regulatory constraints on banks. Okay, so in a way that's saying that it would be nice in maybe another paper also to think more about what are the right macro foundation for this holding cost function. Should we think more about regulatory constraints? Should we think more about search models? But then we also have to think about, search models could give you a different effect for the effect on market size on asset pricing. So here I have a feeling that market size doesn't really matter if you scale up everything. I don't know actually, but that's a question. If you have a bigger market, do you have an effect on your asset pricing or not? And if you microfund this holding cost also, then how do we think about the central bank holding cost function? So here it seems to me it's a little bit harder for me intuitively to think about it for the intermediary. So I can see your argument about financial distress, etc. For the central bank, it seems that the risk that it faces is a bit different. So I'm curious to have your view on that. All right. Let me just skip that and just before I conclude, say that I think a super interesting extension would be to think more about cyclicality. So in this paper, you don't have much about cycles. And I think it's important in several ways. It's important because of the effect of monetary policy on constraints. So again, this is this time variation in the parameter of the H function. It's also important specifically for climate, because we do have this ETS market, so in Europe, which determines the price of carbon. And the carbon price is now, it started at €5, it's now 60 euros. So it did go up, so it's not trivial, but it has, of course, so far it has a cyclical component. So it goes down, it went down massively during COVID and it went back up. So it's kind of interesting because that means that if we don't fix optimally the price of carbon, and it has this cyclical component like that, you can also complement in a way this ETS market by using the central bank purchases, thinking about what to do during troughs and during booms. And that would mean that this unconventional policy should be potentially optimal to continue them post ELB. So it would be interesting to look at this interaction between ETS market and these policies from a cyclical point of view. Okay, so the optimal policies, I think I want to leave time for discussion, so I won't go for that. So I just conclude and say that I really think it's a beautiful modeling. It opens the door to so many possible extensions. You have very interesting results on a number of things, including the size of the central bank balance sheets. I think the extensions of greatest interest would be with cyclicality, with heterogeneous intermediaries, thinking about maturity structure, and possibly, thinking more about the risk side of the model. And I'll stop there.
Thank you very much, Hélène. So I would suggest that Monica start answering Hélène's questions. And meanwhile, please raise your hands for questions in the chat. So we open it for Q&As as well.
So first, thanks, Hélène, for an amazing discussion. I would like to have the slides so I can digest this longer. This is great. You asked about the how accurate scope the different measures of emissions are. There are papers that document that different data sources on scope 1 emissions actually agree a lot. And in fact, what we did was use individual level emissions on scope 1 for individual firms and aggregate them up to the sector. And that number exactly matched the sectoral emissions from Eurostat air emission accounts. So that's one confirmation that scope 1 is well measured, where databases disagree on indirect emissions, not so much scope 2. Scope 2 is also well measured, but scope 3, where you start summing up all the emissions by downstream and upstream producers and also use of the products, that's where you get disagreements. This is why I wanted to have the main fact with scope 1. Scope 1 is pretty uncontroversial, but then with scope 3, it's there's more uncertainty, in my mind, more uncertainty about what these numbers are. You mentioned substitution between, so basically bank loans and bonds. And in fact, this is what we saw in 2016. A lot of firms then started issuing bonds. And so exactly, we need to understand what's on bank loans in terms of corporate bonds. And this is exactly what we're working on right now. So they say, yeah, I have the exact same reaction. We need to understand not just the corporate bond purchase program, but really whom do banks lend to? And in fact, you have now central banks who make it cheaper for banks to loan to green firms, like the Bank of Japan started to have lower capital charges for green loans for banks. So that's exactly what we need to understand. In terms of the how these regulations affect the program, basically this is data from 2016, where not much regulation yet had started in terms of climate regulation. So this is basically before we became super aware that climate change is an issue. And the way I think about these holding costs is basically they're integrating over many different intermediaries. And as you say, they may be very heterogeneous. So right now it's just representing the typical cost of these intermediaries. And it's fantastic to think about how the different intermediaries react differently to different situations and how their pricing kernels change. This is great. Thanks.
Okay, thank you, Monica. So let's collect a couple of questions from the audience. I see Anusha has a question for you.
Thanks, Katerina. So Monica, I completely second what Hélène said. I think that this is a very important paper, and it's a really lucid exposition of what green monetary policy would entail. And so if we look at the data in terms of debt finance, you're absolutely right. If we look at the data in the US as well, we see higher leverage in sectors with tangible assets. And so this mechanically means that they have more, say, with bond finance, they have more bonds outstanding. So you didn't get time during your presentation to talk about optimal policy design. So I was just wondering if you could sort of elucidate a little more about the implications for optimal policy design for asset purchases. For the sake of argument, let's just say in the absence of a carbon tax, while, and whether it's possible to preserve monetary neutrality. Thank you.
the result is that in the absence of a carbon tax, the central bank can improve welfare by trying to make it costlier for brown farms to get financing. The way to do it would be to buy green assets. It basically means shorting climate risk. If the central bank did that, then it would get more expensive. The portfolios of intermediaries would have more green assets, more brown assets. Green assets would go to the central bank. So the climate risk would sit on intermediaries' balance sheets, and they would price it higher because now the central bank is even shorting that risk. And so that would be a channel through which the central bank can do good because it's now improving the climate with green asset purchases. So there's scope to do that. So it wouldn't be market neutral, of course, because you are trying to make it hard. So the welfare improvement comes exactly because you are not being market neutral. You are making it more costly for brown farms to get financing.
Hi. Yes. Hi, Monica. Great paper, great discussion. So just a small question prompted by the comments of Ellen on cyclicality, but more to try to understand that picture that is super striking about the current portfolio of the ECB. I was wondering, and maybe you have shown this and I missed that, but so is the portfolio of the ECB, does it reflect the cyclicality of the different sectors where is there any rationale to think what's behind the current portfolio of the ECB, that it's of course different from the green technology? Meaning that do you think that do you know if the ECB is biased towards sectors that are more cyclical in a sense to help them more in
so they're not. If I didn't bring the picture of comparing the portfolio with the amount of bonds outstanding, and so the amount of bond outstanding, the ECB basically nails that proportionality. It just buys mechanically. It just tells its traders mechanically to buy more of firms that have more bonds. And so that doesn't check any other, there's no other consideration, like whether these are more cyclical firms or anything. So the ECB, this is why it's using this market neutrality term. It says we're being market neutral, we just do mechanically this rule where we buy more of what's more. And so the cyclicality doesn't enter the purchase decision. And I sort of view, yes, we're sort of used to think about these purchases as something that is done in a downturn. But what's interesting about QE in particular is that these assets get bought and then they stay on the balance sheet for many, many years. So then they're never sold again. So it's not really a cyclical policy. It's just you buy it and you hold on to it till maturity. And you keep buying, you never stop buying. Like the ECB hasn't really stopped buying, so they just keep buying. So this is why I think we need to think about these policies in a medium-term frequency. So this is not a high-frequency policy that you do in the middle of the recession and then you stop it. At least this is not our experience with this type of policy. Our experience has been you buy, you hang on to the bond.
Thanks.
Alessandra, I see your hand.
Yes, so I was just, we talk about this, but I was just wondering about the intersection between, your findings and this other phenomenon that is the market concentration. And I'm thinking about US and I'm thinking about the literature, looking at, how much market concentration has been going up and whether there is some sort of intersection between the two phenomena. You see in some sectors that may have happened more, and whether that will make more likely, will make this distortion, this bias towards brown sectors more likely, having more concentration and more market power in that precise sector. Whether you have any sense on in the data, one can actually look at that, because then you will have that one policy can also sort of like have, you know, an effect on two different targets, which is on one hand getting the market power and control, but on the other hand also fixing a little bit the externality coming from this proportionality that they're using as a second best kind of target. Yeah.
Yes, absolutely. This is an important comment. This will interact with other imperfections, and one of them is market power. I thought the empirical evidence, Yu and Ma had a nice paper at the EFG meeting that was showing that the industries where market concentration is increasing the most are the ones where there's a lot of intangible capital. So those sectors don't tend to have many bonds. So in terms of the whole interaction of how will this play out in a corporate bond purchase program, is that it seems to be market concentration is mostly in services and other sectors that don't have much tangible capital, while the corporate bond purchase program is concentrated on firms that have a lot of it, or a lot of tangible capital. So it seems to be separate trends, but they may still be interacting.
Yeah, thanks. What about protection?
Yes, so protection, again, it would be really interesting to, for example, the steel sector is one of the most heavily protected.
That's what I was thinking.
Including in Europe, and so here there's protection, so they have rents, and in addition they're getting cheap financing from the ECB. So it's those things definitely.
Yeah, I was thinking about this dynamic mechanism that could eventually, you know, sort of reinforce each other over time and make the ones that are getting the credit even more likely to be stronger and more likely to get it in the future. So.
Yeah. I think so just in terms of thinking tangible versus intangible, that would not do it, but protections and other things that would definitely lead to an interplay where the subset of firms that is benefiting and has rents is also getting some cheap financing, and so that would be the worst case.
Yeah, the dynamics could go really wrong at that point. You really need to fix that. Yeah.
Yes, yeah, absolutely. So here in the model so far, we haven't thought about other features of firms yet, but firms are heterogeneous in many dimensions that are non-desirable. Here we have emissions, but market power is another one.
Love this paper.
Even more, so you could be thinking about more dimensions of heterogeneity, which are going to be important. Yeah, absolutely.
Yeah, and maybe the last question by Marina.
I was also kind of thinking about one of these dimensions, which is some of these sectors will be more intensive in using labor, and a lot of central banks have the objective of stabilizing employment. So you could be, counteracting you might be at odds also on that dimension.
Yes,
because maybe the services, look different than some of the dirtier sectors.
Exactly. And so, for example, size of companies will matter. And so a lot of the small companies have a disproportionate share of employment. And to the extent that these small companies don't issue any bonds, they're not going to benefit from these policies. And so size would be the other dimension, and then its effect on employment. Absolutely. These are other features of heterogeneity, which are going to matter once you think about which effects these policies have on the cross-section of firms. There are different features of firms that will be affected. And so how many workers they have is definitely something that the central bank even would want to affect. But
I was wondering whether you wouldn't be against the primary objective of the government, which is to keep unemployment low, if you want to push for greener policies. I mean, there's
going to be conflicts. Yes, totally. There's going to be conflicts because you have, you're here benefiting mostly large companies that issue bonds, while smaller companies, they may not benefit as much, and they are actually the ones who hire most of the workers. Totally.
So we are out of time, so we need to close the session here. I'm sorry, but and due to the late time, there will be no formal breakout room after this session. But I would like to ask all of you who are interested in keep discussing the papers presented in the last sessions to stay in the main room, because we will leave it open for 15 minutes after we close it. And otherwise, I would like to thank our speakers for these very interesting presentations. And once again, I also want to thank all of you. A huge thank you goes to all speakers, all chairs, but also to all of you who offered to take care of the breakout room. I have to say that it is amazing the level of engagement and the quality of the interaction we had in these 2 days. I really enjoyed it very, very much, and I'm sure that there will be many more similar events to come. And actually, I think we should already look forward to the US Women in Macro Conference that, if I remember correctly, will happen in the spring. And this is a conference organized by Alessandra, Marina, and Veronica, which were a great source of inspiration for us. And we really want to thank them for the support and also for joining forces across continents. And maybe if you already have a date, you want to remind us about your date?
We don't have a date yet, but we are working on it. And I want to also thank you, Caterina and Helen, for the amazing program and the amazing conference and organization. We were probably the first, but we definitely need to learn a lot. The oil was a great touch, and so the conference we will organize, we'll hope is gonna be in person. I think in the spring. But we will send dates soon. We are still trying to figure out what works for the in-person organization.
So we are looking forward to that. And I will let Ellen, where are you?
I just wanted to say also thank you to Marina for tweeting so much right now. And also, but I think, Katrina, you were going to say it. Thank you so much to Lydia and to Petra for all the handling.
Exactly. Without them, all this would have not been possible. So thank you very much, Lydia and Petra.
It was great and inspiring to work across, the ocean together on this. Fantastic.